Continuing chapter 14, adjustable rate mortgages. We're going to go over now the anatomy of an adjustable rate mortgage. Well, what is an adjustable rate mortgage? It's a type of loan that shifts the risk or reward of changing interest rates, because interest rates are always fluctuating. So it shifts the risk or reward of those changing interest rates when they go up or down from the lender to the borrower. Now, a lot of people say, don't get those. They're horrible. You don't want to get an adjustable rate mortgage. Those rates are always going up and down. You never know what your payment's going to be. False, wrong, wrong. There's an adjustment period. They get adjusted once a year on the anniversary of the loan from when it was originated. Now, what determines whether those interest rates go up or down is that it's tied to some sort of an index. That index often is the 1 year US Treasury bill. So, depending on if the interest rates on that go up or down, would be dependent whether your loans rates go up or down. Okay, so what is a margin? Margin is the difference between the cost of the lender getting the money and them lending it to you. It's the markup, it's what they make off of lending. So, that's what the margin is. So, if it costs them 4% to get the money and they want to make 2% on it, how much do they got to charge you as an interest rate? 4 plus 2, 6.
6.
Okay. They got to charge you 6%. All right. Now, the cap is the maximum that the rate can go up in any single adjustment period each year. And there's also a lifetime cap on the loan, the maximum that the interest rate can go up over the entire life of the loan. They call that the ceiling. And an easy way to remember that is here. I'm going to take my spray over here. Let's just pretend this is like a bottle of soda. I got a cap on it. Okay. Let's just pretend this is a bottle of soda, right? And I mix it up. What's preventing it from shooting up? What's this thing called?
The cap.
That's the cap. The cap prevents it from shooting up, just like your interest rates. Now, if this was a bottle of soda and I shook it up like that, and then I took that cap off, it's going to be able to shoot up. But how high can it shoot up? What's going to stop it?
The ceiling.
The ceiling. So that's a good way to try to remember which one is the annual, the cap, and the ceiling is the maximum it could go up. Okay. And then when you get an adjustable rate mortgage, they also spell out for you on the paperwork what is the worst case scenario, the highest the interest rate can possibly go up. What would be the highest your monthly mortgage payment would be? They actually spell that out to you, and on a piece of paper that they spell it out that the borrower needs to actually sign off on. If this is that piece of paper, the text is about this big. That's like almost a third of the page. So people said, "Oh, I didn't know." Are you blind? That's probably like the only excuse why you wouldn't have known, but you initialed next to it. All right. So this is the anatomy of an adjustable rate mortgage, or ARM for short. Adjustable rate mortgage shifts the risk or reward of changing interest rates from the lender to the borrower. What does that mean? If interest rates go up, the borrower pays a higher interest rate. But if interest rates go down, the borrower pays a lower interest rate. There we go. Let's highlight this. I got a little write up here about this too, because a lot of people blamed adjustable rate mortgages for the crash of the real estate market, but it was way more than just a type of loan and selecting the wrong loan for your application. Okay. So A lot of people blame the real estate mortgage market crash in 2006 on adjustable rate mortgages. However, there was a lot more to it than that. If you watch the movie called The Big Short, it does a decent job explaining what happened in the mortgage industry, uh, taking the politicians' blame out of it. Okay. Even though the entire thing can probably be blamed on the politicians. Um, the movie The Big Short is about a mortgage market crash of 2006. I actually have a link here to it. Let's see. Uh, you guys ever see this movie, The Big Short?
Yeah, it's a good movie.
Got some pretty big names there: Christian Bale, Steve Carell, Ryan Gosling, Brad Pitt, yada, yada, yada. Marissa Tomei. Look at that. All right. So this is The Big Short. Let me go back to the slideshow so you guys can continue doing your notes. I'm sorry about that. Now, it doesn't completely cover the political decisions of House oversight and the banking industry by the regulators and political decisions made by politicians over the years that allowed the reckless spending practices and even encouraged them under the guise of writing more loans to poor people and minorities to get into housing. And later on, this came to be known as predatory lending. So basically, let me see something. Okay, so basically, if you remember a guy used to be in Congress, his name was Barney Frank. You may still see him as a pundit on some news programs every now and then, screaming at the screen. But this guy, he had that horrible lisp when he talks, and he's always shouting over people. But he was the head of the House Oversight Committee on Banking, and he had a hearing. If you ever watch C-SPAN, most people I know do not. The boring congressional hearings, watching them, but he had this thing where he called in the banking regulators for the oversight. They go out, inspect the banks, make sure that they're not not doing illegal stuff. All right, make sure they're not this, making sure that banks are following the banking laws, and writing loans properly, um, and all that good stuff, following all the banking regulations and laws. So Barney Frank pulled in his own regulators, and he asked them, started grilling them, asking them, um, how come how come all these banks are not writing more loans to poor people and people of color? And the regulators were like, well, first of all, banks lend money. It's risk-based lending. They lend money based on their risk. So you have to take into consideration the person's income and their debts that they pay, their debt to income ratios. You have to take a look at their credit scores to see what their history was and their likelihood of paying it back. And then it's up to the lender to decide if they're going to lend their money or not based off of this. As far as lending to people of color, it has nothing to do with that. They're not allowed to look at that or consider that. That's that's discriminatory if they were even to consider it. Whether granting a loan or denying a loan of somebody based on their color, that's illegal by the laws, by the federal laws, the Federal Fair Housing Act of 1968. And he's like, I don't want to hear any of that. That's exactly how he talks, and that's how he acted. He was like, I don't want to hear any of that. He's like, if banks don't start writing more loans to poor people and minorities, we're going to start fining them heavily, and maybe even take their licenses away. And banks, they listen to these hearings. They're like, say what? Say what now? You're gonna fine us heavily and possibly take our license away if we don't start writing more loans to poor people and minorities. Okay, so let me ask you a question. How do you write more loans to poor people? I mean, poor people know what they can afford. they know that they're not going to try to overextend themselves by trying to go out and get a loan, or probably even know that they may not even qualify for it because they're already overextended. So how do you lend money to people who can't qualify for the loan or can't qualify for as much of a loan that's needed in order to buy a house? What do you do? What would banks do to make it so that poor people can afford houses where they previously could not?
Lower the interest rate.
Lower the interest rate. Mm, interest rate has more to deal with how much you could. Um, uh, it affects a little bit on how much you could borrow. Um, what else? What else?
Lower their expectations. Like, maybe accept a
Oh,
lower
no, no, no,
credit
no, no, no,
score.
no, 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 no. It's not about lowering expectations. We need to get more poor people into housing. That's
Well,
what he
I
was.
mean, in terms of the like their credit score, like saying, okay, instead of, where you need a 650 to qualify, maybe lower it to a 600.
You mean lower the standards, the
The
lending
standard, yeah.
standards?
Sorry, not the expectation, the standard.
Okay. All right. Yeah. But let me ask you a question. If you lower the lending standards so that people who previously could not uh, afford to be able to borrow that enough money to buy a house, you lower the lending standards so now that they can. What does that do to the people who previously could already afford to borrow?
When they're borrowing even more.
They could borrow even more, right? So if people can borrow more, what are homeowners going to want for their homes?
More.
It's not rocket science, right? I mean, anybody can figure this out, right?
Mhm.
So that's what the lenders did. They lowered the lending standards. As a matter of fact, how do you get a loan? What do you got to do to get a loan to buy a house?
Give up your first child.
Other than that,
You have to qualify.
okay, well, what does that entail?
Um,
I'm playing stupid. You got to explain it to me.
okay, well, they're going to run a credit check.
Okay,
Um, they're going to look to see what your debt to income ratio is.
okay.
They want to make sure that you have a job, that you're employed,
Why?
um, to ensure, so they feel confident that you can actually afford the payments.
And what do they base that on? Just having any job?
No, so you have to be there between a specific amount of time, at least a year or
Uh,
2 years, depending on
3 years.
how long you were there. If you switch jobs, I think there's something, if I'm not mistaken, they look at that, right? In terms of
Do they care about how much money I'm making though?
yes,
Yes.
Okay. Oh, do I
because you need to be able to afford the loan.
have to have any assets or anything that I need to show them, or tax returns or anything?
The
Do
tax
you have
return.
to have assets? You don't have to have assets, but you need to be able to show your tax returns.
So I don't need
Um,
to have any money in the bank to show them.
Yeah, you do.
That's an
uh,
asset. You know, the money you have in the bank. How do you make? Are you required to have down payments or money for closing costs, or show where that money's coming from?
All of that.
yeah.
Okay.
All of the above.
Well, you know what they actually did? They actually made up all kinds of loan programs, like one called SISA, stands for Stated Income, Stated Assets. It's actually making a comeback too. You know what that is?
Yeah, where you
You
don't have
just
to prove it. You just
you
say
don't have,
it.
it's
You state
right.
it. It's true.
You don't need to prove it. You just need to tell them how much money you're making and what your assets are. Sounds kind of crazy, huh? You don't need to show your tax returns or any of that.
To buy
You
a
just
house.
tell them, hey, this is my job and this is how much money I make. And none of it is verified. And they basically go off of what you tell them. And they lend you money based on that. What could possibly go wrong? You think people were out there lying about how much money they were making just so they could qualify for a loan to get a house that they could buy when real estate prices were shooting up? And they knew that, hey, if I get into a house, hey, prices the way that they're shooting up, I'm going to make money on this. So that's exactly what people were doing. All right. All right. So, okay. So that's how you get poor people to be able to afford to get a house there where they normally would not be able to. All right. Now, how do you get minorities to be able to purchase a home? I mean, anybody can purchase a home. Anybody can walk into a bank and try to apply at least. So, how do you get more minorities to get loans to buy houses? Because remember, he said he wanted more poor people and minorities to be buying homes. So, how do you get more people in there?
You,
you you target them. You got to target them through your advertising and marketing, right? Where where do this minority group or this minority group, where do they go to shop? Where do they go for entertainment? Where do they go for uh what are their favorite things to do, you know? And then you got to find those things and then advertise the hell out of them getting special programs or whatever for the rates for them. You get into housing, get loans through us, but you're only targeting a specific group of people. That's what came to be known as predatory lending later on. Once those people got those loans and they started to default, they're like, "Hey, we never were out trying to get this. You guys were targeting us with your marketing and advertising, trying to get us to buy these homes. And now, you know, the market crash. Now you brought us into financial hardships because you were a predator. You were preying on us. That's predatory lending." Right? But the banks did it because they were threatened. They were told, we're going to fine you heavily or yank your license to be able to enter into banking. So that's why I say politicians are squarely to blame for this because, sure, there's other parties that played a role in it, but that's once the banks were threatened by the politicians. Now, let's just say that Barney Frank had no ill will. He was well intentioned in his things. It doesn't matter. The road to hell is paved with the best of intentions, right? So yeah, you get predatory lending. You pull poor people into financial hardships beyond what they were previously at by having them be able to get loans that you knew that they were going to be defaulting on. Even the banking regulators said, but they're going to be defaulting on these. We know there's going to be a large percentage of defaults if we change this and that. And you say, I don't care. I want more people to get into housing and have the opportunity to live the American dream. Da, 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 da. Okay. So they opened up the floodgates. And if you know how you see the COVID curve, how that worked, everybody knows about the curve and how to read a chart with a curve, right? Well, when this happened, you saw that spike of home prices going up at a sharp, steep incline. Matter of fact, I'm going to show it to you. Boom, boom, boom. So the housing market took off from there like a rocket. Okay, so I'm going to share it with you on my screen here. I'm just pulling it up, queuing it up for you. Okay, here we go. See this? Real estate markets are always cyclical. They go up, they got their highs, they got their lows. They got their highs, they got their lows. But historically, they climb over time a little bit, right? Up, down, up, down. Uh, Here around 1978 or so, Jimmy Carter was president. He passed something called the Community Reinvestment Act. That that gave a little bump, and then you started to see property values more steadily increase because it opened up borrowing a little bit more for people. Then around 2001, I think it was President Clinton was in there, and he made some tweaks to the Community Reinvestment Act, and it started rising even more. little steadier space. And then around that same time, oh wait, no, a couple of years later, when Barack Obama was president, Barney Frank was the head of the uh, uh, banking committee, the oversight committee. And when he had that hearing and he made all those demands, this is what happened. So you see how property values were steadily going up already, but they were going up steady, but at a reasonable pace, not nothing crazy. But when he started threatening those banks, this is what happened. Property values started shooting up like a rock because more people could get loans and borrow more money. And so homeowners wanted more. So property values started shooting up like a rock. And this is around time where I got my real estate license, maybe about right here in 2004. And then property values just kept going up and up and up and up and up. Look at that. And we knew, I was new and I was like, this is unsustainable. How the hell can property values? I'll never afford a house at this rate. How could property values keep going up like this? This is a bubble. It's going to burst. Are these people? Is everybody that stupid? Nobody's paying attention to this. And look, I'm like new to real estate. I'm like, this don't seem right. And then sure enough, 2006, that bubble burst. But I should say in 2006, it popped a little. It didn't burst. Between 2006 and 2008, that's when it started taking that sharp decline here where it changed. And then property values kept going down and down and down. And then politicians were like, oh my gosh, we got to do something about this. We got a couple of years now where property values are just going down, 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 down. The economy is taking a huge hit. People are getting foreclosed on. We need to start, renegotiating people's loan terms and stuff to keep them in houses, prevent foreclosure. We need to stop this bubble. So in all their arrogance, politicians, they said, we got the solution. Because in all their arrogance, they think they always have the solution to stuff. Like this is how this whole thing started, right? They had the solution to get more poor people and minorities into housing, right? Now they got the solution to stop it. How do you stop a bubble from bursting? Well, you can't. All you could really do is lengthen the period of time that it takes to deflate. And that's basically what they did, because they started offering tax credits to anybody who would rush out and buy a house. So in 2008, they all started offering, or was it 2008, 2009, somewhere around that period? It was 2008. They started offering a tax credit for people to rush out and buy a house of what was it, $7,500 tax credit. So what happened there? People did rush out and start buying houses. They said, oh, that should be enough to be a cushion. We got to be near the bottom of the bubble bursting now, right? But if you look at it, where did the bubble start? Somewhere way down here, right? We're nowhere near the market correcting itself from that artificial bubble that was created by politicians. So they offered that $7,500 tax credit for anybody who rushed out and bought a house. And so for that full year, the curve started to flatten a bit. I mean, it was still going down, but just not as a tremendous rate. So people were rushing out saying, hey, got a $7,500 cushion. That should cushion any further drop in the market, should be good, right? Now, the condition to get this tax credit was you had to live in the house for at least 3 years. Otherwise, you had to pay all that money back to the IRS. All right. So at the end of 2008, when that tax credit went away, the market started to correct itself again, and poof, the bubble started bursting again. Now, the people started rushing out. Real estate agents started helping people doing short sales, and when we were able to save people from the foreclosure, and they closed and sold the house, if they didn't live in it for at least 3 years, which most of them didn't, there was a knock on the door. We are the IRS. You owe us $7,500, please. payable now, or you got to pay us late fees and penalties and interest. So they actually pulled more people into financial hardship by doing this. The rescue, right? All right. So what happened? Property values continued to fall and drop again. So politicians and all their arrogance said, we had something there though. Look, we flattened the curve. What the problem was, we didn't throw enough money at it. So they did a second bailout, this time for $11,000. And yes, that flattened the curve even more for a time being. That was between 2009 and 2010. And it did flatten the curve even more, but the property value still kept falling, but just at a slighter pace. And then what happens when that one went away at the end of the year? Ooh, the bubble started bursting again, and the IRS said, we need our $11,000, if you didn't live in that house for at least 3 years, which most of the people didn't. So all the politicians managed to do was lengthen out how long it took for the market to correct itself instead of just dropping like a brick to where it should be and then correcting itself naturally. All they managed to do was lengthen the period of time that it required for that market to correct itself by and pulling more people into financial hardships in the process by offering these tax credits. Okay. And then when the market eventually adjusted and corrected itself, wait a minute, where did we end up? Right where we started. You see that red line? If you draw that straight across, if it were to just go straight, that's where we would have been anyway. So these market increases and then bursts and trying to slow it down and offering tax credits and everything, all that managed to do is just lengthen and draw out how long it took the market to correct itself. All right. And then you had this period of time that, okay, so the market started correcting itself. It stopped about here, kept falling. Then you had, actually, yeah, Bush was president around this time. Then you had Barack Obama became president around this time, and the market still fell a little bit. He started doing some things with all the bailouts and all that crap, and then some things he started doing, but not. I mean, the president was limited in how much he could do to try to change the market around, but try to wait it out. And then he started it started to correct itself once we started reaching the bottom. Okay. And then things started getting better, a little bit better. And then election time came around again. And we had, so for the longest time, 8 years he was president, it was pretty much flat, or it was in that downward curve, still going down, then became flat, and then started coming up a little bit. And then we had another election. President Trump came in. He started doing all kinds of stuff. Remember those famous words? What are you going to do? Wave your magic wand and change around the economy? Well, he did some things and he did wave his magic wand, and then this started happening. The property values and the economy started improving. But property values kept going up and up and up. And that wasn't entirely President Trump's doing. What causes the property values to go up in any market?
Demand.
Supply and demand, right?
Mm-hmm.
So what happened during this period? We continued to have open borders and ignore our immigration laws, right? And flooded 13 to 15 million people, additional people came into the United States. We had a shortage for housing. So much so, properties that were closed, hotels, motels, the government started leasing them out above market rates so that they could house these people. And then they started having more and more houses being built. And so property values with the shortage and the demand kept going up at an insane rate. We're not talking about the economy here. We're just talking about the property values. Okay. and they kept going up and 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 up. We're still kind of there. We're still at this point that they're still rising. You know, it's slowed down. We're in the curve somewhere around here right now, right? Because the property values are still going up, but they're not going up as steeply anymore, but they're still going up. So we're somewhere around this point. Are we at the bubble yet? Are we at that apex yet? Or are property values still going to go up? See, right now, we're at this point that we don't know what's going to happen next. You know, President Trump is doing a lot right now to try to improve our economy and stabilize it, put a solid foundation under that. A lot of people are not recognizing it yet because we're not feeling it yet. But he's been doing a lot of stuff with all these, not just the tariff things, but there's a lot of stuff in the background that he's doing to try to stabilize the markets. That it should be starting to kick in mid to late next year. That we'll really start feeling an improvement in the economy. Because right now, affordability, you're hearing it in the news all the time, right? Affordability is the issue. So, and that's not even talking about housing. It's talking about I guess it's housing and expenses for all kinds of stuff. So we're somewhere around here right now. Now, are we going to continue going up, or is the real estate market going to take a crash? And if it does, where is it going to just stabilize? Is it going to fall down here, here, here? What's going to happen? Your guess is as good as mine on this. This is why we got to stay tuned and keep on top of monitoring political decisions that our politicians are making, not just the president, but also the Congress, also our state. Look, I just seen this morning. Hold on. Anybody renew their health care recently? Anybody renew their health insurance recently?
No,
I
not
know a
yet.
girl. I know a girl. She's collecting on the. She was getting the Affordable Care Act insurance, and she paid nothing for it. Right? She's low income, so she got not. She paid nothing for it, and now she's all ticked off. She's like, I got to pay now $150 a month. Previously, I didn't pay nothing. And I was like, well, yeah, she's looking at the president for it. The president's fault. I'm like, well, each state has their own, health care programs and how they issue them out. Federal government may give subsidies, but it's the states and how they use that money. We're a sanctuary state. We're giving a lot of health care and subsidies to a lot of people who may not have contributed. But either way, where the hell is it? I'm trying to find it. Hold a second. The news this morning. But either way, that plays a role. Here I'm seeing the news this morning that I'm seeing here. New Jersey healthcare is broke and headed for collapse next year unless members agree to pay thousands of dollars more for their coverage. Now Murphy wants $250 million for a bailout. So New Jersey health insurance program is broke. Murphy proposes $260 million bailout to save it. So if you haven't renewed it yet, you may notice you're going to be paying a little more in health insurance this year. This girl that previously was paying nothing, now she's paying $150 a month for health insurance. Okay. So there's a lot of different wheels at play here right now, a lot of gears at play that could contribute to this. Now, if you don't want to monitor all this stuff, be the political pundits to monitor changes in politics and all these other different issues in order to see where real estate is going. Remember I told you about that CMA class you could take to learn how to value properties? Yep. Well, they also give market updates. They monitor all this stuff, employment rates, political decisions, all kinds of crap. And they specifically do it for New Jersey. So if you take one of these classes that they have, if you don't take the CMA class because they're not offering it right now, take one of their market updates, their market workshops. They give you a they give you a full detailed explanation of what they're expecting to happen in the next quarter, just the next quarter, the next 3 months uh, in New Jersey in real estate and different areas of the state. So now you could try to target your business and adjust it a little bit more if if you have a better idea of what's going to happen where. And they give you how they came up with the synopsis. They give you all the evidence and everything. So it's actually a pretty good classes to take for Mark to stay on top of market updates. If you want to be a really good agent, you got to be on top of these things. And if you're not sitting there monitoring the business news and the political news and all this stuff to try to then be able to analyze it, formulate it, and see where the hell's how it's going to affect real estate, I suggest you guys subscribe to these classes and newsletters and go to them. They're very informative, especially if you want to be a top agent in the area. So my 2 cents. That OTTEAU.com, that Ottawa.com. So anyway, that 2000 that the movie The Big Short, it leaves the political decisions out of it as far as what politicians did what, and it tries to leave the blame out of it because it is Hollywood, and they do side with certain people. But the movie does a pretty decent job explaining how real estate markets started going up. They showed how bus drivers were claiming they made $300,000 a year so that they could buy a house. There's a scene in that movie where you got this stripper. She bought like 6 houses, and then the guy asks her, he's like, "Well, what are you going to do when the interest rates adjust?" Because she got an adjustable rate mortgage that was fixed for the first couple of years, and then it becomes adjustable. So he was like, "Well, what are you going to do when the loan starts to adjust and the rates go up and your payments go up?" And then she stopped dancing because he was interviewing her at the dance club while she was dancing, and he was like, she was like, "What? What do you mean they're going up?" She's like, "Where's my mortgage rep? Where's my realtor?" She started flipping out. So that was a funny scene, the stripper scene in that The Big Short. Yeah. Watch that movie. It's actually pretty good, and it is a pretty good, accurate detail. Why do they name it The Big Short? Well, because have you guys ever heard of investing in stocks? How do you invest in stocks? You buy low, you sell high, right? That's how you make money in stock, right? But do you know that you could also invest in stocks another way? It's called shorting the stock. You're betting that the stock will fail and go down. And The Big Short is a movie about them doing a big investment that in the United States that our financial system would fall. And they couldn't believe it, so they were trying to go out and do all this research to check on that, and before they invested all this money, this huge investment group. And that's basically what this movie was about. Check it out. It's not a bad flick, especially now that you're taking a real estate class and you could relate a little bit more. So it wouldn't be as boring because you could relate to it. Here, let me put this up here. I'll share that.
Victor, before you go on, you mentioned a website for where we could learn and about these updates.
Yes.
Was it OTTEAU.com?
Yep.
Okay.
OTTEAU.com. I'll share that with you again. That I highly suggest it for learning for them to teach you how to do CMAs, to how to value properties. This is the page. Did I switch to it? Yes, this is a page. This is the page, the Ottawa group. It's OTTEAU.com. I'll copy that and I'll share it with you here in the chat window.
Thank
Okay.
you.
Now they have classes specifically that they make for real estate agents, teaching you how to do valuations. It's their CMA workshop. Let me see if you click on events. You go to their advanced CMA workshop. They have a CMA workshop and an advanced CMA workshop. They usually hold them at the same time. You got to be determined. So you got to contact them and see when they're going to have their next one. between September and October. They were having their fall market workshop. You could reach out to them, see if they're planning on having another workshop anytime soon. Either way, when I sign up and I pay for a subscription to them, $100 a year, and that gets me cheaper. When I go to these workshops, I get like $10 off on them, and I also get invited to special events that they hold that are not being advertised. They're for members only, and they got this market track. You know, see, this is that one that $99 a year. The Market Pro Plus is the one that I sign up for because it also includes this Ask Jeff. He's the owner of the company. Like if you're ever doing a valuation of a property and you're having difficulty trying to find comps or value it, you could actually send this guy a message. You could either call him or email him. I think now it's just email. But you could send him a message and talk to him, explain it to him, and he'll consult with you. He'll give you a call, he'll consult with you, and give you help in valuing that property. Not bad for $99 a year, right? And you get access to Housing Track, market news, member only events, discounts for other training programs that they have. And I pay the $99 a year. And look, I got the account, my account. I subscribe to it. I think it's worth it. So let's go to the dashboard, my waiting list. What's my waiting list? No pre-orders, recent order. No. My Market Track subscription, Access Market Track. Market Track here, look, I could see they let it out for November. We're in November now. So each county, each of the 21 counties, they have a report for all the municipalities in each of the 21 counties of a market update of where they expect the market to go, what's going to happen, what's affecting real estate. They also have the market news, which is an overall news for the entire state. And then they got the Ask Jeff, where you could ask this guy a question, send them questions and inquiries. So you get access to this. It's worth it. And plus, you could use these market updates to maybe update your own blogs with the information. Don't post these. Don't download these and post these. They're copyrighted. But you could take the information from these reports and make your own stories based on them. So make it your own news, right? I think it's definitely worth taking just so that you could stay informed and on top of it. All right. Enough of that. So adjustable rate mortgages, a lot of people blame them for the crash of the real estate market. They played a big role, but they weren't the only things. How did they play a big role? Well, like the one example I gave you with the stripper in that movie, The Big Short, a lot of people get adjustable rate mortgages because they usually have a teaser rate that's fixed at a below market interest rate. So the lowest interest rate you could get out there right now, if you were to be able to get a loan at an interest rate even lower than that, and it was fixed for a year, 3 years, 5 years, or even 7 years, would that be very enticing to people to use that kind of loan? Sure. So now what they'll do is they'll get these loans and hopes that they'll get an adjustable rate mortgage because it's fixed at a lower rate and lower payment for a period of time. And then they said, you know what? That's just to get into housing. And then as the property values go up and I build more equity, I'll just refinance it to a fixed rate loan. Is that gambling?
Yeah, I guess.
Yeah. Sorry.
Yeah, because
you don't know what the rates are going to be.
Yeah, you don't know what's going to happen in the market. You're like, yeah, I'll get these adjustable rate mortgages that are fixed for the first couple of years, and by then, the values keep going up. I'll just refinance it to a fixed rate loan. But what happens if the bubble bursts and the values go down? What is refinancing? It's getting a new loan to pay off your existing one. But what if the house is no longer worth what you borrowed, what you owe? Are you going to be able to get a loan more than what the property's worth? Remember, the property's to serve as collateral for the loan. So if that property's not worth what you owe, how are you going to get a loan to refinance and pay off the existing one? You're not. So it's gambling. And a lot of people did that. And so these did play a big role in there because people were getting these adjustable rate mortgages with the teaser rates at the beginning that were fixed for a little while. We call those hybrid mortgages, by the way. If it's not adjustable from day one, it's fixed for a while and then it becomes adjustable. It's a hybrid mortgage because it's a mix between fixed and adjustable. So here's the anatomy. Let's just go over these parts. The cap is the maximum interest rate can go up in any single adjustment period. That's the cap. And then the ceiling, sometimes called the lifetime cap, is the maximum allowable interest rate over the life of the loan. Okay.
Got it.
So an amortized loan, the word amortized means to kill off over time, slowly over time, right? And then we learned about a partially amortized loan. And then we learned about a straight loan, which is an interest-only loan that doesn't amortize at all. Now we're learning about something called negative amortization. It's the opposite of amortizing. Wait, if amortize means to kill off, negative amortization, that means every time you make a payment, you owe more money. How could that happen? If your monthly payment isn't even enough to cover the interest owed, they'll take the shortfall and add it to the balance that you owe next month.
That's legal?
That ain't a good situation, is it?
Not at all.
Yeah, it is. Look, some of these adjustable rate mortgages that are offering you below market interest rates that are fixed during the teaser period, that they start off negatively amortizing. However, the lender eats the loss on that because they know it's going to become adjustable. They'll make it up in the long run.
Got it.
But we also have programs out there like this. Do you have a loan where you may be able to have a loan if you go online where you can make a payment? It gives you a choice of what your payment's going to be. You can make your regular monthly payment, or sometimes, finances are a little tight and they allow you to make a payment less. So interest only or less than interest only. Less than interest only is negative amortization. And giving people the option, some people will always choose the lowest payment possible. And that's not a good situation. So the lenders will allow you to do it, but only for so long, because even they start to feel sorry for you after a while, when you get in that situation. But that's negative amortization. When the monthly payment is less than the interest owed, that's usually on exams, by the way, knowing negative amortization, that term. So every month you make a mortgage payment, you owe more money. And it depends on your payments if you end up in this situation. Or the type of loan, like these adjustable rate mortgages that are fixed with the teaser rates for a little while at the beginning. But however, the consumer doesn't feel that because the lender will eat that loss to try to entice you into the adjustable rate mortgage, because it takes the risk out of their side if you get an adjustable rate mortgage. Because if the interest rates go up or down, you will benefit or lose. Instead of the bank gambling, you will be. Now, adjustable rate mortgages, they're best for short-term ownership or when the borrower plans to refinance later to a fixed rate loan. But once again, that's gambling. It can be risky if property values drop. So let's highlight in the book there, negative amortization, when the monthly payment isn't enough to cover the interest owed or the interest due. So even they say here, not all mortgage plans include the possibility of negative amortization. Sometimes the lender agrees to absorb any shortfalls. The possibility must always be explored, however, when an ARM is being evaluated. Okay. So that was page 270. Everybody got that? Okay. All right. Payment plans, hybrid mortgage loans. Oh, I told you that's where it's fixed at the beginning and then it becomes adjustable. And you could have them fixed for 1, 3, 5, 7 years even. But the way those ones work is the first year it'll be fixed at a below market teaser rate. And then year 2, it'll go up to a market rate, but a low market rate. And it'll be fixed at that for the remainder of those fixed period of years. And then after that, it becomes adjustable. Straight loan is an interest-only loan. You lower the monthly payments. Lower monthly payments are possible because you're not paying down the debt. You're not amortizing the loan. You're just paying the interest only. That can be risky, especially for people who are using this loan for the wrong reasons. If you're planning on living in a house for a long term, you don't get straight loans. You'll never pay them off. See, the lenders aren't there to advise you which loan you should take. They got a bunch of different loan programs for different reasons, and people can take out whatever loan they want for whatever reason they want. That's up to you to do. They're not there to advise or counsel you on what type of loan is best for you. They're there just to see if you qualify for it and sell you that loan.
But can they counsel people, or is that like against their, I don't know, code of conduct?
Well, they could, but you know what? Who's counseling you? The mortgage reps that are selling you the loans, that are making the money off of selling you the loans?
Yeah, right. That's true.
And some of those guys, they get trained to just about selling, like they have regular office meetings and they train you about which products to push because they got the biggest markup on them this month or next month or whatever.
Got it.
Yeah. So, I would take it with a grain of salt. Some of those guys really don't even know what the hell they're doing. They always push the FHA loan programs. They don't even educate themselves. So if you were to ask them, well, what about a USDA loan or a VA loan or a 203K loan? They'll be like, yeah, you know what? This one's better. How is it better? You should be that kid in the back seat. Are we there yet? How is it better? Keep asking more questions. Otherwise, they'll just try to push you on whatever they make money on. Some loans interest only for part of the term, and then payments will significantly increase later. So these interest only loans are straight loans. They're short term interest only loans. They could be used by builders and people who fix and flip houses. But they could also be used as bridge loans when somebody needs to sell their existing home, but they need to put an offer in on the next home before they sold the existing home. They need to get a bridge loan to manage to be able to make the payment on 2 mortgages for that short term. And eventually, when they sell their existing home, they pay off the bridge loan in full.
Well, how long would it take to get a bridge loan? Seems like
pretty quick.
So faster than like a traditional loan, and you get it from your existing loan carrier. Okay.
Yep.
Loan holder.
Mm-hmm.
Got it. Okay.
So here, let's read about it a little bit here. When high interest rates are zooming property values make it impossible for many home buyers to afford traditional mortgage loans, some lenders offer interest-only mortgages which have lower monthly payments because the debt's not being amortized. Many financial experts consider these risky because the homeowner's not reducing the debt. If prices stop rising or even fall, owners who had to sell might find themselves underwater or upside down, owing more than the house would bring in a sale. With some plans, the interest-only provision lasts only for a given number of years. Okay, I'm not talking about those types. The bridge loan is not for a period of years. It's usually not more than 6 months and being interest only. If it goes out between 6 months to a year, they could charge you interest on it and often do, but it's a low interest because it's only meant to bridge the gap until you sell your existing home. Okay. But builders use these all the time, these interest-only loans. The thing is, it's interesting how they work, though. The loans are paid out in installments as phases of the construction get done. And then the builder has to let the bank know their schedule on what their estimated time frame is to actually sell the property so that they'll pay off the loan. And if they go over it by a certain amount of time, they'll pay a penalty. And if they go over it by a longer amount of time, that penalty gets bigger, and it's a monthly charge. I've had builders that made their estimates and they shot way over them and were unable to sell the house in that estimated time frame. And then each month they were paying a fine of $3,500 a month to the lender. So there's your motivation to sell it. Adjust your price, get rid of the damn thing so you can pay back the loan, builder. You may have been asking too much at the wrong time or doing something. I actually know one builder that went out of business because of that. All right, so interest. What is interest? Interest is the rent that you pay for the use of someone else's money. It's a charge that you pay to use someone else's money. Why would anybody lend you money? Because there got to be something in it for them, right? They got to make some money out of it. So that's the interest. So interest is calculated on an annual basis, not a monthly basis, but an annual basis. We'll go over those charges on the next coming slides. Now, an amortization schedule is a chart that shows the balance of your loan, how payments are being applied towards the principal and towards the interest over the entire life of the loan, and what the running balance would be at any given time. So you could look, say a 30-year mortgage has 360 months in 30-year mortgage. Okay. 12 months times 30 years, 360. You can look at any particular month within that 360 payments that you're going to make over 30 years, and you can see what your monthly payment is, how much of it gets applied towards interest, how much gets applied towards principal, and what the balance is at any given point over the life of the loan. They call that an amortization schedule. On the next slide, let me get to it. Here, this slide here shows you the first 3 months and the last 3 months of a fully amortized fixed rate loan. You see the payment is the same throughout. The first payment all the way to the last is the same. The only thing that changes is how much of the monthly payment gets applied towards the principal and how much gets applied towards the interest. And you can see what the balance of the loan is at any given point. Don't worry, we'll get back to that. A point, sometimes referred to as discount points, are interest. It's interest, prepaid interest on the loan. Okay, well, why would anybody want to prepay interest on their loan? Well, maybe because their debt to income ratio is so out of whack that they have to in order to qualify for the loan. Or sometimes they do it to try to buy a lower interest rate. We call that a buy down. Don't ever do that. If you've got extra money to try to purchase a lower interest rate, you're better off just making an extra payment on your loan, lowering the balance that they could charge you interest on. Right. Right. Remember, we were talking about that, the biweekly mortgages. You can make that extra payment. So if you got that extra money, instead of trying to purchase a lower interest rate by prepaying the interest, your money is more valuable in your pocket, or just buying down that loan by or paying down the principal on that loan. So any prepaid interest on the loan is tax deductible by the borrower in the year it is paid. Each point is equal to 1% of the loan amount, not the purchase price. And it may be paid by either the buyer or the seller in negotiations. So, yeah, maybe you could negotiate that the seller pay points on the buyer's loan so that they could get a lower interest rate. But if it's your own money as a buyer, don't buy a lower interest rate. Buy downs suck. Just use that money to pay down your principal. Okay. So the interest is tax deductible by the borrower in the year it's paid, no matter who paid it. Why is that? Because it's the borrower who gets the tax statement at the end of the year for the interest statement for their taxes on their loan. It's their loan. Now, this is no longer in the book. Actually, I think they did put a little blurb back in, but it doesn't really explain it in any detail. What a rate lock is. Let me see, where did they put that? Okay, page 271. I think they got a reference here. What do they say in the book? A rate lock is guaranteed by the lender to issue the loan at the quoted interest rate as an incentive to the borrower. Under some conditions, the rate can still change. Okay, so here I got a little better explanation. What is a rate lock? The lender locks in the rate, so even if the interest rates rise, the borrower gets the lower locked-in interest rate. And the lender can lock it in for 30, 45, or 60 days, and they usually do so complimentary. But if the borrower does not close on time, their rates could go up if the interest rates went up. But they could purchase an extension of the rate lock for an additional fee for hundreds of dollars more. So if that complimentary rate lock period expires. This is why real estate agents seem like they're always pushing the buyer to get this done, get that done. Come on, get to the closing, get to the finish line, and if you don't educate your clients, it seems to them you just wanted to rush to the closing so that you could get paid your commission. And that's the impression they get. You need to educate them why you're rushing them. Say, yeah, I am rushing you. I want you to get everything done in a timely manner. And it's not for me just to get my commission. It's so that you don't overshoot the rate lock so that you could get that lower interest rate. Because if you overshoot it, you could still get the lower interest rate, but you're going to have to pay hundreds or thousands of dollars to keep it. So let's highlight their interest is a charge for the use of someone else's money. It's called interest or the rent, right? All right. So we went over here, interest, amortization, what a point is, who could deduct it on their taxes, and what a rate lock is, because the book doesn't really have a good explanation of what a rate lock is.
Yeah, I was gonna ask you about that.
Yeah.
Well, I'll let you get to it. It's gonna come up.
Well, no, the book just got a little blurb about it. I just went over it. The rate lock, once again, is the lender locks in the interest rate. So, you shop around to get a good interest rate on your loan, right? But rates are always going up and down. They're always fluctuating. So once you find the house, they give you that pre-qualification letter at a certain interest rate, but that interest rate's still fluctuating. But they'll honor that interest rate for you, and they'll give you a rate lock on it for 30, 45, or 60 days. Now, on average, it takes about 60 days to close on a house. So they're not going to actually lock in the rate until you find a house. And once you find in a house, they'll tell you what the rate is then, and they'll lock you in. Now you have 60 days to close on that house. If you go over that, and interest rates rise, well, you'll have to pay the higher interest rate. Or you could pay an additional fee for an extension of that rate lock to keep that lower interest rate. Okay, that's why you need to explain to your clients why we're always pushing them to get this done and that done so that they could close on time in a timely manner. Otherwise, they start thinking it's about us just being greedy, wanting to get paid our commission. My real estate agents, they just kept pushing me the whole time. Get this, get that. They just were in a hurry to get paid their commission. No, that's the impression they're going to have if you don't explain it to them, though. That's why I said you'll be a better agent if you educate your clients and explain to them why you're doing this. You could tell them, hey, listen, throughout this transaction, it's going to seem like I'm pushing you. I am, because I want you to get that locked in rate that you were able to find, that low interest rate you got. I want you to be able to get it. And if we go over, we take too much time, you could miss the rate lock. And the only way to keep that low interest rate is to pay for an extension, which could be hundreds or thousands of dollars. So I'm trying to help you keep that low interest rate. That's what I'm doing. That's my job. That's part of my job. Right? But if you don't educate them and tell them how you're helping them out, they're not going to appreciate it. Oh, my agent was always pushing me because they just wanted to get paid their commission. Okay?
Nope.
And the book, like I said, the book only has a one-liner here. It says a rate lock is a guarantee by the lender to issue a loan at the quoted interest rate as an incentive to the borrower. Under some circumstances, the rates can still change. That's all they have there. Okay. Here I have a little more explanation here, so of what an actual rate lock is. Okay. So this whole slide you should probably take a screenshot of too.
Got it.
All right.
Got it.
So here, I got another one just about the rate lock. It has that same explanation. And here's an actual screenshot from an older version book. This is not in this book. You're not going to find this anywhere in this book. This is from the 15th version of the book. It was removed from the 16th by mistake, and they still haven't put it back in, and we're on the 18th version. The only thing they put in now is that two-line explanation of a rate lock that I just read. That doesn't really tell you much. Okay, so lenders may offer the borrowers an opportunity to lock in a quoted rate. In this situation, the lender agrees to hold the quoted rate for a certain period of time. If interest rates go up, the borrower is protected. Unfortunately, if the interest rates go down, the borrower often cannot take advantage. Sure, they can. They can just tell them, I'm going to go to a different lender to get the loan if you don't match it. Borrowers typically can lock in the rate for 30, 45, or 60 days and hope they could get to closing before the rate lock expires. And for an additional fee, the rate lock can be extended. All right, so interest is the charge, the rent for the use of borrowing someone else's money. And here is a formula for calculating interest. You take the loan amount times the interest rate. That gives you the annual interest rate. You divide that by 12 if you have 12 monthly mortgage payments to get the monthly interest. And then you could subtract that from your total mortgage payment, which consists of principal and interest, to figure out how much of that monthly mortgage payment actually went towards paying down your principal. That's the formula that they use to create that mortgage amortization chart that shows you, what your balance is, how much of the monthly payment goes toward the principal, how much goes towards the interest. They do this math formula once for every month of the term. So 360 times for a 30-year mortgage. Okay. That's the formula on how to do it. So the formula of how to calculate monthly payment towards principal is PI minus I equals the P. Principal and interest, that's what your monthly mortgage payment consists of. If we're just talking about the loan, we're not talking about if you added your homeowner's insurance and taxes in it. This is only talking about the loan amount. Your loan payment consists of principal and interest. Principal is the amount you borrowed, and interest is the charge for that you pay for using that money. If you subtract the interest from the principal and interest, you could see how much of that monthly payment goes towards paying down your principal. So some people, look, they have an example. I got an example here. If you have a loan of $100,000 at a 7% interest rate and a monthly mortgage payment, including principal and interest, is $665.31. How much of that first month's mortgage payment, that $665.31, goes towards paying down the principal, the amount you borrowed? Well, in the problem here, they tell you the interest rate 7%. You borrowed $100,000. Interest is calculated on an annual basis. So 100,000 times 7%, that's $7,000. Divided by 12, and that first month's interest payment is $583.33. Subtract that from your total monthly mortgage payment of $665.31, and $81.97 of that mortgage payment went towards paying down what you borrowed. So you make a $665.31 mortgage payment, only $81 went towards and 97 cents went towards paying down what you owe. So what's the balance of my loan now? Well, $100,000 minus $81.97. So next month, your remaining balance is $99,918.03.
That's crazy.
Now you want to find out how much your next month mortgage payment, how much of your next month's mortgage payment goes towards the principal? Well, start off at square one, but instead of using 100,000, use this figure. And you do that once for each month. And that's how you create a mortgage amortization chart. Okay, so your mortgage payment alone consists of principal and interest. But if you want to know what your total monthly housing expense is, we call that PITI. Principal and interest, that's the loan, plus your property tax and homeowner's insurance payment. You add all that up, and that's your PITI payment. Some people also call it a budget loan, because with your monthly mortgage payment also includes your property taxes and homeowner's insurance, so you could budget a little bit better, they say. Okay. So on page 272, you guys may want to put a highlighted box around this and write above that, calculating interest and amortization annually. This is on page 272. Under interest, you'll see this, but you don't have this title. You got to write this in there. Calculating interest and amortization annually. We're just calculating interest and amortization. And at the bottom of that page, you can see the first 3 months and the last 3 months of the amortization chart. See, this is $665.31. That's your PI. That's the principal and interest. That's your total monthly mortgage payment. This I, that's the interest only. And how do we calculate that? Well, we took the loan amount times the interest rate and then divided it by 12. And this is how much, after we subtracted that interest from your total monthly mortgage payment, that's how much went towards the principal. Okay. By the way, this formula is pretty good to have too.
Got it.
This, that's that. So what's your monthly mortgage payment? It's the PI. If it includes the property taxes and homeowners insurance, we call that a PITI loan. A PITI or budget loan. What does PITI stand for? You need to know that. Principal, interest, taxes, and insurance. Okay, so here on the bottom of page 272, in the first 3 months and the last 3 months of a 30-year mortgage, correct this. There's a typo in the book there. This is a 3. It should be an 8 on the second payment for the interest. Okie dokie. By the way, there's a beginning of class attendance poll. Let me throw that out. Whoever didn't answer it, you want to answer the attendance poll? Thank you. So, how do lenders figure out what your monthly mortgage payment's going to be? Well, they use a mortgage factor chart. I'm going to show you now how to use this chart. You've got the term, the length of the mortgage loan. That's we call that the term. And then this is the interest rate. So the way that this works is this. If you have let me just show you. If you have a 4% interest rate on your loan, you take one finger, put it on where it says rate, and run it down to where it says number 4. That's 4%. Now run it across to the right until you get to the 30-year, and you get 4.78. That's your mortgage factor. Well, what is a mortgage factor? What is that 4.78? For every $1,000 you borrow, your monthly mortgage payment, including principal and interest, is $4.78. So your mortgage payment's $4.78. So if you borrowed $300,000, how many thousands are there in 300,000? You could just put
300.
Yeah, just cross out the last 3 digits, the last 3 zeros. It's 300. So 300 times $4.78 is $300 times 4.78, $4.78.
1434.
That's your monthly mortgage payment for a $300,000 loan at a 4% interest rate, $1,434, including principal and interest. That's your PI, principal and interest. So on a 30-year fixed mortgage at a 4% interest rate, your monthly payment, first payment to the last payment, is $1,434, not counting property taxes or homeowners insurance. This is just the loan. Okay, so here I show you on the side, that's the formula to figure it out. This is how you figure it out. Okay, so now I want you to tell me, what is the factor on a 25-year loan at a 6% interest rate? What is the factor on a 25-year loan at a 6% interest rate? Remember, just put your finger on the chart, run it down to 6%, and then run it across to the 25-year column.
6.44.
Yep, that's right. I just want to make sure you guys know how to read the chart, because if you can't read the chart, you're not going to be able to figure out the math. Okay. All right. So, anybody else other than Kevin now? What about a 5% interest rate on a 20-year loan?
660.
Okay. Jaron, you there? I want you to figure out this one. What about a 7% interest rate at 30 years?
Hold on. 7% on 30 years is, you said run it across the top. Hold on.
You run it down the bottom on the left side all the way till you get down to
7%
7%.
over. I gotta
And
move my little.
then all the way over to 30 years.
7% is 6.65.
That's correct. Okay. So you guys know how to read the chart. It's pretty simple. It's not rocket science, right? There's nothing difficult about this, right? So this is the first step though in figuring out what your monthly mortgage payment is. This is how lenders figure it out. They'll have a chart like this that will this is how they calculate what the mortgage payment's going to be. And it's based on per $1,000 borrowed. So let's give you a problem here, shall we? If you have a what? Let me see. I got a whole problem worked out here, but I didn't put down what the factor was. Great. 20 years. Well, I'll figure it out just a second. Give me 1 sec. Okay. I figured it out. Okay, I got a problem for you guys. Let's see if you guys can figure this out, all right? If you have a 30-year loan at a 7% interest rate, 30-year loan, 7% interest rate for $300,000. What is your monthly mortgage payment? The principal and interest, the PI.
1995.
And what is the factor you got for 7% at 30 years?
665.
Does everybody agree with him?
I'll be able to tell you in just a moment.
Okay.
But don't wait for me because it might be like 4 minutes.
Okay.
Sorry.
Kev, what about you? Did you work that out? You got a calculator handy?
Just give me 1 second.
Sure thing.
Nice. Wait, I'm ahead. Jonathan, how much you get?
What did you get for your monthly mortgage payment? 30 years, 30-year loan
I got 1995.
at a 7% interest rate.
Yeah.
What is
Yeah, I got the 1995.
okay. All right. So now that you got 1995, that's your monthly mortgage payment, including principal and interest. If your property taxes are $9,500 annually, and the annual insurance is $900, what is your PITI payment? The principal, interest, taxes, and insurance. So your mortgage payment plus your taxes and insurance. What is your monthly mortgage payment on a $300,000 loan at 7% interest for 30 years? We figured out that the PI was $19.95. If your taxes are $9,500 a year and the insurance is $900 a year, what is your PITI payment, the total monthly expense for housing? Don't shout it out. If you get it, I want you to send it in the
chat.
Send it in the chat to me. Make sure you pick me in the drop down. I just want to make sure that everybody has a chance to try to figure it out. Okay.
All right.
Here's a question. The 95 was for principal.
Taxes. 9,500 is for taxes, and 900 is for homeowners insurance a year. You already figured out that the mortgage loan is $1,995. That's your PI. I want you to figure out what the TI is, the taxes and insurance, the monthly taxes and insurance, and then add that to the PI to get the PI TI. All right, Jonathan, you've rounded up, right?
Yes, sir. I was just about to tell you that.
Okay. All right. So for the taxes and insurance, the taxes are $9,500 a year, and the insurance is $900 a year. The way to do this is you just add those two up, and then divide it by 12 to get the monthly. And then you take that amount, you add it to your PI, your 1995.
Should we say it or just send
Yeah,
it?
you could say it. You could say it.
28 2,861 I get.
And 66 cents, correct.
And 60, yeah,
Yep.
0.66.
Yep, that's right. Okay, so I just want you to see how to figure this out. All you do is you take your annual figures, add them up, and then you divide it by 12 to get the monthly. And now that's your monthly PI. I'm sorry, TI, taxes and insurance. So you had 866.66 for the taxes and insurance, right?
Yes.
All right, so this is factor chart helps you figure out the PI, the monthly mortgage payment. But sometimes people have their taxes and insurance included in their mortgage payment. If that's the case, we just figured out how to add that up and figure it out the monthly payment on that, and then add it to your monthly mortgage payment to figure out what your pity payment is. So don't worry, I'll have a couple more examples we'll do on screen. All right, but before I do, let's talk about tax deduction loophole limits, because when this book was created, this was the law, but some things have changed and I made some edits here on screen. Trump attempted to end, President Trump, he attempted to end the tax loopholes for the rich. Remember, because everybody was always screaming about Trump. He's for the rich people. Everything about him, he's all for the rich. He's all for the rich, Wall Street, and the rich. Well, don't look at what people say. Look at their actions. Judge them by their actions and what they do. Because he may be rich and he likes to pal around with the rich, but he likes taking their money too. So he actually created a law that negatively impacted the rich. Okay, so Trump attempted to end tax loopholes for the rich, at least somewhat. However, this negatively impacts states that have very high property taxes for those with expensive. What the hell? Doesn't even make sense. Negatively impacts states with very high property taxes for those with expensive taxes. Okay, so this points out which states have extremely high taxes, and New Jersey is one of them. That right up there, I got to adjust because that doesn't even make sense, and I never even realized it before. Look at that. If I could find the slide we're on. Okay, so Trump attempted to end tax loopholes for the rich somewhat. However, this negatively impacts states with very high property taxes. I guess we could just leave that there. This points out which states have extremely high taxes, New Jersey being one of them. Yeah, we got the highest taxes. So there was something called the Tax Cuts and Jobs Act, or TCJA, which is in effect from 2018 until 2025. It expires this year. So that needs to get voted if they're going to extend it or not, right? And this allows homeowners to deduct interest on qualified home loans up to $750,000. They're allowed to deduct their interest payments, down from $1 million that it previously was in 2017. For taxpayers who use married filing separate status, the home acquisition debt limit for single filers was $375,000. The new law ended the deduction for interest on home equity lines of credit until 2026, unless one condition is met. The home equity line of credit or home equity loans are used to pay for improvements for the home. So people are not just taking cash out refi to go on vacation or buy expensive cars or do whatever, right? He doesn't want people using their house as a piggy bank. That's what got them into a lot of trouble with the mortgage crash and meltdown too. People were doing refinancing on their houses as their home values were shooting up. Hey, next year it's worth 100,000 more than it was last year. So let's refinance and take 100 grand out and buy some stuff with it. And then when property values start to crash, they're like, oh, I don't want to pay back that loan. My house isn't even worth that anymore. Why should I pay it out? Well, because you already cashed out the money and you used it. That's why, So these things lead to that. But nobody's asking that pertinent question there that points out the obvious. Okay. You, as real estate agents, if you're ever in this situation where markets change like that, you could point that out to homeowners. You already cashed it out, you already enjoyed it, you know. So the upper limit to the state and local tax deduction, the SALT deduction, is let me see what they got here in the book. Page is this? 273. I'm on the wrong page. Oh, here we go. It's actually on the top of page 274. Was at $10,000. $10,000. What's the average taxes in New Jersey? Property taxes? Anybody know?
It's over that, right? Like 15?
The average property tax in New Jersey is 90, it's 95 or 9,700, something like that. I think it's 9,500 is the average. The average. However, there's a lot of people that pay way more.
Oh, yeah.
And there's some people that pay way less.
Way less. Yeah.
Okay. But the average is 9,500. Is that a lot of money?
Yes.
Yeah. I don't know about you guys. It is to me. You know, $9,500. It's a lot of cash. Especially if you go to look at other states, see what they charge for property taxes. If you go over to Pennsylvania, is that an average property tax? $9,500 a year for your property tax?
No, it's probably half of that.
You go to most states, it probably is much, much less, right? So that was a pretty generous amount. So people who own homes that have taxes in that high range, they're usually generally rich people. Remember, the president, the president's there to working with everybody throughout the country, right? So if the average throughout the country is far, far less than that, you know, you'd figure $10,000, that's more than enough to generous. And people who are paying more than $10,000 in property taxes probably have a mansion, you know, or a very expensive home, unless you live in a state where your politicians rip you off and tax you through the nose. New Jersey is one of those states. And it just kind of points out the obvious. It's not the president that's doing this. It's your local politicians that are. Bitch and complain to them. So that's why he made that at $10,000. But now you had a lot of people in blue states like New Jersey. You know, blue states, you know, we're talking about politics again. Blue states, Democrat state. A lot of these Democrat-run states like New Jersey, Illinois, California, extremely high taxes. Why is that? Well, you got to ask that to your politicians. I don't know. That's a rhetorical question. Okay. So you figured, hey, $10,000, that's an acceptable amount. But now you had most of the politicians are complaining about that. And even some Republicans. But which Republicans are complaining about that? The ones that are elected in blue states. Right? So they're trying to get reelected. So this time around, President Trump was like, all right, we'll raise that amount. We'll raise it to 40,000. Are you happy with 40,000? Is 40,000 considered cheap annual property taxes? No. Okay, so now all the people in blue states are happy now because you could deduct. You got this SALT tax deduction of up to $40,000 if you pay up to $40,000 a year of property taxes. That's an insane amount of money. I can't even fathom paying that much a year in taxes. A lot of people don't even make that much money a year, let alone paying that much in taxes, right? That's definitely like rich territory. So this limit has been particularly hard on property owners in New Jersey, New York, and California because these states have very high taxes. Different income tax regulations apply to mortgage loans on investment properties. Licensees should always recommend clients consult with a qualified tax professional because we're not tax professionals. Okay, so if you were to judge President Trump, everybody's talking about how he's there to protect the rich people. But then you see the laws that he passed, they were definitely not there to protect rich people. They were actually there to tax them, to get their fair share. Isn't that what everybody was always screaming about and complaining about him? And then when he does it, then they're like, yo, what are you doing? we're in a high tax state. Well, complain to your politicians about that. You know, I'm trying, you want me to penalize the rich. This is how I penalize the rich. But then when I do it, now you complain. But I'm not rich. Well, you're paying taxes like you are. All right. So this year he raised it to $40,000. And these Tax Cut and Job Act tax limits, where you could deduct the interest on your mortgage loan. If you're a married couple, it used to be a $1 million home. Now it's down. He lowered it to 750. And if you're a single filer, you could deduct it up to $375,000 valued home.
Is that purchase price or current market price?
That's based on the purchase price, and then after that, I think it goes based on the value, the current value.
Okay.
Okay. So, but this expires in 2025, and he made this to renew. Otherwise, you cannot deduct your interest on your loan. So this is supposed to renew this year. You notice we had a government shutdown recently for quite a while. It didn't just, that government shutdown wasn't just over a single issue. It was over a lot of different issues. This was one of them. This was included in there. You know, the president's opponents said, you need to raise those limits on those dollar amounts there. And he's like, listen, you need to pass this. Otherwise, people are going to have to pay interest this year on they're not going to be able to deduct the interest on their taxes if we don't get this passed. This is why it was very important that they passed this this budget here, because the budget wasn't just a budget, it's also a bunch of bills in there that they needed to pass. Okay, they're still renegotiating on some of them. Well, this was part of the big beautiful bill, but that was part of the budget too. But they did not pass the budget. Still, they did not pass the budget. They only passed the continuing resolution that continued to fund the government as it is in operation. So politicians in Washington, D.C., they better be passing these laws right now and voting on these things. Otherwise, a lot of people are going to not be able to deduct their interest on their taxes. And the SALT limits that is not going to get raised to 40,000 if they don't pass it. So you see how politics plays a role in real estate at all levels, the presidential level as well as the local level. All right. Just want to point out the obvious. Well, it's not always so obvious if you don't pay attention to these things. You know, most people don't pay attention to politics. They just got their sides. I'm Republican, I'm a Democrat, I'm an independent. You know, they don't, and that's the team they always root for, but they don't really get into the details of the politics. You know, it's all, they're all crooked. You know, but then why do you keep voting for the same people? Yeah. So, but it does play a role, especially in real estate. Politics does play a big role. That's just what I want to point out. I don't care what side of the aisle you're on. I'm just saying you need to be aware of how it plays a role in real estate and be honest with yourself, especially if you're going to be in the business of real estate. Now, one thing I just want to look up over here is this Tax Cut and Job Act, if the limits have changed. Let's take a look. Has the Tax Cut and Jobs Act deductible interest changed? Okay, yes, it's part of the big beautiful bill. Let me get my glasses here because I'm really trying to see this here. Okay, so the One Big Beautiful Bill Act of 2025 made it permanent, the interest deduction on the limitations originally set by the Tax Cut and Jobs Act of 2017. Okay, so of 2017. Oh, so he rolled it back to the $1 million limit because they were complaining that he wow. So President Trump, in 28 between 2018 2025, he lowered it so that millionaires don't get that deduction. So he lowered it for 700 homes valued at 750 or 375. That's what it used to be, and he lowered it to this. Well, they complained enough, so he also raised it back to what it used to be in 2017, and then he made it permanent. Yep. It was set to revert to the pre-Tax Cuts and Jobs Act with that $1 million cap. All right. And that SALT Act reverted from 10,000 back to 40,000 or to 40,000. Wow. So now the rich people get their deductions, and now all the political parties are happy. All right. So you could change that in the book now because it's official, where it says $10,000 next to SALT on top of page 274. Change that to 40,000 because it's now 40,000. Cross that 10,000 out and put 40. You don't need to know this for exams. This is just real life stuff. Okay. You guys notice some things we're teaching you are real life, some things are for exams, but you don't need to know this for exams. They're not going to ask you about what the limits are, the debt acquisition limits or the write-offs or on the interest, etc. Okay. Let's go back to now the points. What is a point other than a message we're trying to get across? A point is prepaid interest on the loan, and it is equal. What is the math of a point then? Each point is equal to 1% of the loan amount. It is important for you to understand that so you could get a certain math problem right. So let's highlight this. Prepaid interest. A point, let's just highlight the word point over here. And then we go up here and say prepaid interest. Each point is 1% of the new loan. And then go down here and highlight the IRS allows the buyer to deduct them. Because you get the interest statement every year that you could then file your taxes. But you need to know what a point is and what it's based on. Let me know when everybody's got that.
Got it.
Got it.
And I already discussed what a buy down is. It's a way for you to purchase a lower interest rate. So, like I said here, this is my note. The borrower is better off using that money to pay down the purchase price and borrow less for the lower balance the lender can charge interest on. The money is more valuable in your pocket today than it is down the road, especially if you don't own the property long enough for the savings to pay for the lower interest rate. Okay. Sometimes people will prepay interest just so that they could be able to qualify for the loan because their debt to income ratio is so out of whack. Other times it could be used to purchase a lower interest rate, but it usually doesn't make sense to do that unless you're going to be in that house for a really long time. But if you're in the house for a really long time, if interest rates fall, you could have just refinanced into a lower interest rate and not paid money out of your pocket to get a lower interest rate. You follow what I'm saying?
Yep.
Don't use your money to buy a lower interest rate.
Are these lower interest rates? I see that it could be temporary, like 3 years, 2 years, 1 year, or like a certain percentage for a period of time.
Yep.
There's also, I see permanent buy down. How would that be charged? Like, how would you?
You got to ask the lender what they're charging you for it.
Huh.
Usually it's not like an equal thing. It's like if you pay 1.1%, you don't get a 1% lower interest rate. It's not an equal buy down. Usually it's like this. If you pay 1%, they'll lower your interest rate by an eighth of a percent, an eighth of a point.
Mm.
That math don't jive.
Yeah, right. Mm-mm.
Right? Yeah, don't do that. You're better off using, if you got that kind of money, you're better off using that extra money to prepay the principal, lower what you owe so they could charge you less interest on it throughout the rest of the year.
Right.
All right. But anyway, understanding just what a buy down is. It's prepaying interest to get a lower interest rate. Okay. Now, here we go. What about mortgages? In risk-based lending, because that's what it is, the best interest rate you could get is tied to the amount of risk to the lender. It's all based on the risk to the lender. Factors include the down payment amount, your FICO credit score, that stands for the Fair Isaacs and Company credit scoring system. That's what FICO stands for. Your DTI, that's your debt to income ratio comparison, the value and condition of the property you're purchasing, and the local market conditions. Are property values steady, declining, or on the incline? PITI payments include property taxes and insurance in the monthly bill. So principal, interest, property tax, and insurance. That's what PITI stands for. Equals PITI. So PITI reserves go towards next year's payments of bills. What are PITI reserves? Your closing costs. When you go buy a house, what makes up the majority of your closing costs? Building up a reserve account towards next year's to pay next year's property taxes and homeowners insurance, because you're going to have the lender pay it, including it in the mortgage loan. So you're not just going to be making your mortgage payments. You're going to also have to build up a reserve to pay next year's property taxes and homeowners insurance. The lender has limits on how much they could charge you for reserves in advance. The total monthly expense for housing, plus any HOA fees if it's a condo, would go towards that. A PITI loan is also known as a budget loan. Why? Because you could budget your expenses better if all of your monthly expenses for housing are included in one payment. But it's not a bad idea. You could still, you don't need to include your property taxes and homeowners insurance in your monthly mortgage payment. You could pay them separately on your own. And if you do that, it could benefit you in the event the lender ever wants to foreclose on you because you aren't making your mortgage payments. Because the first thing a judge is going to ask is, what are the property taxes and insurance being included in the loan? Or actually, the judge is not going to care about the insurance. They can say, are the taxes included in the loan? No. You're paying them separately. Are you paying them? Oh, okay. You are paying them. Then they'll be a little bit more flexible to the borrower, to the homeowner, as far as the foreclosure goes. Because how does the judge get paid?
Taxes.
They want to make sure you're paying his salary. They tend to be a little more flexible if you are. But if their taxes are included in that mortgage payment and you're not making the mortgage payment, damn, this is an issue we need to fix. Foreclosure granted. So lenders will incentivize borrowers to include the property taxes and homeowners insurance in the monthly mortgage payment to ensure those important bills are being paid. They often offer you an eighth of a point discount on the interest rate if you do. Everything's an eighth of a point. If you pay a point, you could do a buy down and get an eighth of a point. If you include your property taxes and homeowners insurance, they'll give you an eighth of a point discount on your loan, on your loan interest rate. Reserves is an amount of money built up for the coming year's future expenses. And the first time you're charged in advance is at the closing table to help build up that reserve account for the closing for the coming year's expenses. That's what your closing costs consist of. So property taxes and insurance, that's what the reserve account is. Now, RESPA is the Real Estate Settlement Procedures Act. Actually, I should separate this. So it's a separate bullet point there. There we go. RESPA is the Real Estate Settlement Procedures Act, and it limits the amount of reserves a lender can charge. Lenders have to do periodic accounting and must return excess money in the reserve account over $50 above whatever limits the lenders are allowed to collect. And they got to do that at least once a year. So if you've got a mortgage loan, sometimes you may notice the lender will send you a check because you have an overage, too much money in your reserve account. And then later on, during the year, they did accounting again. Now they say, well, you have a shortfall and your mortgage payment needs to be a little bit higher this month because you got to make up for the shortfall of the amount of money in the reserve account. So sometimes that happens, and that's why it's happening, because it has to deal with the money that they have in the reserve account. That's the lender doing their accounting that they're supposed to be doing. Okay. So taxes and insurance reserves, that's PITI. PITI is principal, interest, taxes, and insurance. And a PITI loan is sometimes referred to as a budget loan. And RESPA, the Federal Real Estate Settlement Procedures Act, limits the amount of taxes and insurance reserves that a lender may require. And they have to do that periodic accounting throughout the year to make sure that they don't have more than $50 above the overages. There's a $50 tolerance leeway that they're allowed. Okay.
Okay.
Check out this Count Dracula looking guy here. He's actually pretty smart, even though I think he has some kind of fetish. He wants to wish that he's Dracula. He even filed down his teeth and he looks like he got fangs. But he's a pretty smart fella. Listen to what he's saying. Has to deal about RESPA law. I am going to have to first adjust my audio control so that you guys get those good audios on the videos. And let me also, come on. Make sure the audio is up there.
This morning from Philadelphia. Hey, Patrick.
Hey, how are you?
I'm doing well. So explain this for us. You actually had a home that Wells Fargo came to you and said, look, you need to take out a homeowner's insurance policy that you don't think it's worth the value of your home. What did you do to Wells Fargo in response?
I told them I wasn't going to renew that policy that they were having me renew. I had an insurance policy on my house, which I had bought for $180,000. And Wells went to the insurance company and said that they wanted me to insure it for $1 million. And as you can imagine, the premium on a policy like that is through the roof. So I said, no, I'm not going to do it. And they said, well, we're going to do it for you. And they force-placed an insurance policy for me that doesn't cover me. It only covers them. And that was the genesis of a dispute with them that's been running for nearly 2 years now.
Well, we did reach out to Wells Fargo, got no response from them. It sounds just like your experience with them, no response at all. Are you surprised by that?
Welcome to the world of dealing with Wells Fargo. No, I'm not surprised at all.
You also then found an interesting loophole, or not a loophole, but you found an interesting law dating back to the 19...
That's his house. That's a pretty nice house. He bought it for $180,000 in Pennsylvania.
Dracula.
See what I mean about New Jersey versus other states and the cost of things, you know?
70s, which enabled you to work this angle, which is they needed to respond to you within 20 days. They needed to respond to you with written responses to your inquiries. They didn't do so, and therefore you were able to place a levy on their office and foreclose on them?
That's true. There's a law called RESPA, and there's a 20-day window that they have to acknowledge receipt of your request, and then they have 60 days to actually respond to that request. And if they don't, it's possible for you to collect damages and even additional fines on top of the damages. So I took them to court here in Philadelphia through the municipal court system. I won a judgment. They ignored the judgment. The court advised them they had to pay. They ignored that court's advice. And so I got a sheriff's levy, and when they ignored that, I ordered a sheriff's sale on their branch in downtown Philadelphia, and they still weren't going to pay. But let me tell you, when the media coverage started and it was on the front page of the business section that their office furniture was going to be sold off to pay a judgment, I had a check in my hands the next day.
Brilliant. And I can imagine a lot of viewers this morning waking up wondering if they're in a similar position. Do you think that your story opens the floodgates for other people watching this morning?
I think it does. I mean, people ask me what I hope to get out of this, and one thing is if I wind up being the Johnny Appleseed of RESPA letters, I would absolutely love for that to be my epitaph. These RESPA letters are not difficult to write. There are numerous consumer resources sites on the internet. There's government sites on the internet that'll help you with that process. And these RESPA letters, the banks are legally required to respond to them. So I would say to consumers, these are a very important tool if you're having a problem communicating with your mortgage lender.
Patrick Rogers from my home city of Philadelphia, good luck to you, and thanks for coming in and telling your story this morning.
Thanks for having me on.
Thanks, Patrick. Coming up here.
Interesting. And another case where a private citizen forecloses on a bank or threatens to foreclose on a bank. You know, he just wanted information clarified. So that's interesting. You know, according to RESPA law, I think there's like 300 regulations that banks need to follow for every loan. And it could be with certain time frames in which they have to give disclosures to consumers to certain information that needs to be provided. And if they don't do it, they could be fined. So what he did is he made a request to them, like he said, and they have to respond that they received his request within 20 days. If they don't, they could get fined. And then they have to actually give an answer to his request within 60 days. And if they don't, they could be fined. And they didn't. So he took them to court. He got a judgment against them. And then he went to try to get a payout. And those judgments can be in the tens of thousands of dollars.
This morning.
So I thought you guys would enjoy that one anyway. But you see his fangs? He did kind of look like Dracula, right? Now, a point is prepaid interest on the loan. It's tax deductible by the borrower in the year it's paid, no matter who paid them. And the math of a point is that each point is equal to 1% of the loan amount, not the purchase price, but the loan amount. So here's a question for you. If the purchase price is $320, this is very similar to a school exam math problem you get, by the way. If you guys get these answers, do not shout them out. Send them to me in the chat window. Make sure you selected my name from the drop down, so it just goes to me. If the purchase price is $325,000 and the buyer has to put 20% down and pay 2 points and $5,000 in closing costs, how much money does the buyer need to purchase? First of all, how do you calculate a point? Let's discuss this. Let's ask a question about the question before we actually fill it out.
It's 1% of the loan amount.
1% of the loan amount. The loan amount.
Right, which isn't here.
So you need to figure out what the loan amount is.
So would that be the 325 minus the 20%?
You got it.
325. Okay.
So go at it. You're allowed to use calculators just like on the exam. The question here is, how much money does that buyer need to close to purchase this house? Let's take a look. I got some answers here. No, Jonathan, that's a lot. That's a lot. Jaren,
let me redo my math.
And Jaren got the same amount. She got the same figure that you did. That's a lot. That's way too much. You don't need that much to purchase this house. I'll give you guys a couple more minutes, then I'll work it out for you right on screen. I'm asking, how much cash does the buyer need to purchase this house? I think you guys included the loan amount there. Based off of my memory, I think you may have it right.
Okay,
Darren.
I think I know what I did wrong.
I think Jaren got it. I think. Oh, no. You were close. You were closer before on the right road. Okay, here. I'll start working it out. Kev, are you close, or you want me to just start working it out on screen?
You can start working it out.
Okay. So here, you take the 300. First of all, you got to figure out what the down payment is, because 325,000 times 20% is $65,000. That's the 20% down payment is $65,000. So right off the bat, you know at least $65,000 that buyer needs to purchase. Now, next step is we need to calculate a point. But a point is calculated based on what? Okay, I think you got it now. A point is based on what?
1% of the loan amount.
Yeah.
Okay, so we have 2% of the loan amount here. So we got to figure out what the loan amount is. 325 minus 65,000 to 20%. The loan amount is $260,000. So 260 times the 2 points, that's $5,200. Plus 5,000 in closing costs. So we have the 65,000, which is the 20% down. Then the 2 points. You don't calculate the 2 points. You don't do 2 times 325 because that's the purchase price, not the loan amount. You'd be paying interest. A point is interest. You'd be paying interest on your own money, your down payment. That's why you need to subtract that down payment first. So you take the $65,000 plus the $5,200, the 2 points, plus that $5,000 in closing costs for a grand total of $75,200. And that would be the correct answer. Everybody see how we got to that? Anybody want to snap a picture of it so that you have it later? You can study it, how we got to it. Because you're going to get a question
Done.
just like this on your school exam. The numbers will be different, but you'll get a question just like it.
Got it. Thank you.
And you see how I write next to all the figures what those figures are so I don't get lost in my math?
Mm-hmm.
That's what you guys should start getting into a habit of doing. Because especially if you got math problems that have multiple steps and you're writing down numbers all over, now you're not just trying to figure out the answer, you're trying to remember what each one of those numbers was, you know, and it makes it even more difficult to stay on track. Okay. So, Kev, you good? You see how we got to that? Kev?
Just give me 1 second. Just
Okay.
trying to figure out something.
So we did this. We took the purchase price, subtract our down payment so that we could calculate the points. We need to figure out the points are calculated based on the loan amount. We needed to figure out what the loan amount was. So to do that, we have to subtract our down payment from the purchase price. But we need to figure out how much is 20% of the purchase price. And 325 times 20%, that's 65,000. And then we took that 65,000 and subtracted it from the purchase price, and that's the loan amount. And now we could calculate the 2 points based off of the loan amount. So 260 times 2%, that gave us 5,200. That's your 2 points. So you have to have that $65,000 plus the 2 points plus $5,000. That is a total of $75,200.
Yeah, I got it now.
Okay.
Uh,
I just want to make sure that everybody understands it. I want you guys to do well. You know, don't freak out over math. Okay, you can use calculators, and I just want to walk you through it. I want to make sure you understand it. Okay. So there you go. Snap pictures, take your screenshots, whatever. That's a lot of money to have to buy a $325,000 house. You got to have $75,200 to purchase it. That's not even including your closing cost. Oh wait, no, it does. 5,000 closing costs. There you go. That's a lot of money to have to purchase a $325,000 house. You got to have $75,200. Only if there was some sort of a program out there that didn't require you to put down so much. Well, we do got them. But before I get into that,
FHA.
Yeah. Let's take a look at this, though. There's another way of wording that same exact question differently that requires you to understand what an LTV is. These two questions are the exact same problem, just worded differently. So this is the one we had from the previous slide, and this one is saying the same exact thing. If the purchase price is $325,000 with an LTV of 80%, what's an LTV? That's how much money they'll loan you. 80% of the value. So how much does a buyer have to put down? If they're lending you 80%, that means you got to put down
20%.
Right? So this is asking the same question, but they're not telling you outright you need to put down 20%. You need to know what an LTV is and figure that part out. So if you're asked this way, that's a little bit craftier way to ask, just to make sure you also know what an LTV is. But it's asking the same exact problem. All right, so now let's take this $325,000 purchase that required us to have $75,200 in order to purchase it. And let's say that we're going to use a different loan product to purchase it, an FHA loan. How much money would you need to purchase that same $325,000 house if you used an FHA loan that only requires 3.5% down payment? You still got to pay 2 points and 5,000 in closing costs. So what's the first step?
The 325 times 3.5.
Yep, we need to figure out how much the down payment actually is and then subtract that from the purchase price so that we could calculate the points, because points are not based on the purchase price, they're based on the loan amount. And here, I'll do it on screen with you guys. So you take your $325,000 times 3.5%. That's $11,375 down payment. You subtract that from the 325,000, and the loan amount is 313,625. Now, what's the next step? I just want you guys to understand the steps. I could care less about the numbers. You guys can use a calculator and figure it. The calculator's doing the math for you. I want to just make sure you guys understand the steps. So what's the next step now that we figured out the loan amount?
So you multiply the loan amount by 2%, so 0.002.
Or 2% if you have a percent button on your calculator, or you go cross this out and go 2 decimal points to the left, boom, boom. So that would be 0.02 is 2%. So 313,625 times 2%, and that's $6,272.50 down payment, which on the other loan, that 2% was less. Why? Well, because you were borrowing less. You were putting more money down. That's why.
Right. And then
okay, next step. Now you add it all up, right?
Wait, the $5,000. You didn't.
Yep.
Okay.
Yeah, 5,000 plus the 5,000 closing costs. So you got your down payment amount plus the points that you just calculated.
Yep. Plus the 5,000.
Plus that 5,000 in closing costs.
That's how much?
22,642 or 647 and 50 cents. Makes it considerably more affordable to get into a house, right? So instead of using the conventional loan that required a 20% down payment, through the FHA loan program that only requires a 3.5% down payment, it makes it more affordable to get into homeownership. Now, keep in mind, you're borrowing more money because you're putting down less, but hey, it's what you could afford, right?
And you're going to pay PMI. How long do you have to pay PMI?
Well, with FHA loan, it's a little bit different. You're paying MIP.
Huh.
MIP, we didn't go over this yet. With an FHA loan, it's not PMI. PMI is when the lender loans you more than 80% of the value, you have to pay private mortgage insurance for the amount less than 20% that you put down on the loan. With an FHA loan, you pay MIP. That's mortgage insurance premium. It insures the entire loan amount. It insures the lender if you default in making your mortgage payments. It tells the lender, hey, lender, lend your money if the borrower meets our lending criteria and the property they're purchasing does as well. And we will insure you against loss, that you will not lose one single penny. So you're going to be paying that MIP. And we'll get into the details of that a little bit later. So look at that. The same house you could get into for 22,000 and change instead of having 75,000 and change. All right. Making it homeownership an achievable dream for many Americans out there, right? So you guys, you want to buy a house, you don't need to have the 75 grand. You get an FHA loan and as little as 22,647 plus closing cost. However, FHA is kind of unique. They allow you to finance the closing costs too. All right, so let's look at this chart here once again. This is how your monthly mortgage payments get applied, right? The dark color part of the bar, this is your first year of mortgage payments, the entire mortgage payment. The dark color part of the bar is going towards how much of that payment goes towards the interest. And the light color here at the very tippy top, that's how much goes towards the principal.
Mm-hmm.
So for at least the first half of your mortgage term, your money gets applied first and mostly to what? In your monthly mortgage payment. Your monthly mortgage payment gets applied first and
Interest.
mostly towards the interest, and then the balance towards the principal. This is the principal up here in the very light color part. And this is that mortgage factor chart, by the way. On page 273 at the top above this chart, I want you to write mortgage. I want you to put a highlighted line and then write mortgage factor chart above that, on top of that highlight. So you know that's a mortgage factor chart. And above it, they have instructions too in the book. Like I have here in the side. Now this chart only goes up to 9%. And only goes down to 3. Just a couple of years back, it's possible to get less than 3%. But that's only for refinancing, not for purchasing. I didn't see that for purchasing anywhere. And we've never seen interest rates that low before in history. Have we ever seen interest rates more than 9%?
In the 80s or early 70s. No, well, that's the 70s or the 80s. I think maybe in the 70s. I didn't see them, but I heard about them.
Well, you could get them right now too, depending on what kind of loan you're getting. You know, if it's a riskier loan, you know, you could be paying more, you could be paying 12%.
Wow.
You know, but yeah, if your parents bought a house in the late 70s, early 80s, it's possible that they had a 16 to 18% interest rate on their loan to buy a house.
Yeah.
Now, of course, the houses were much cheaper than they are today too, but everything is relative, you know, how much were they making and all that, you know. Can you guys imagine that, buying a house at a 15% interest rate?
No.
I showed you at a 5% interest rate for a $300,000 loan, how much that would cost. Now, keep in mind, houses were a lot cheaper not that long ago either, in the late 70s, early 80s, right? Like in my neighborhood where I live right now, I've seen a lot of deeds, original deeds in this neighborhood, where people were buying houses in the, let's just say, 1977, 1978. That's not even the original. These homes were built in the 50s. In 1970s, how much you think the homes were going for in my neighborhood? You guys were all here to pick up your books, right? You came to my house. All these small Cape Cods, maybe 1,000 square feet or a little bit more. What do you think they were going for in the late 70s?
60, 70.
I was going to say that.
Thank you.
60, 70,000. That may be a little bit on the high side still. Isn't it incredible that right now, across the street from me, there was a burnt out shell of a house that sold for over 600. I can't explain it. I don't see it. I don't see that value there. But if people are paying it, you know, that's what determines the market value, whatever someone's willing to pay.
Yeah.
Right?
Yep.
Doesn't matter their reason for it. So, you know, some people can say gentrification because a lot of it is Hasidic Jews moving into the area and they're buying all cash and such. Some of them are getting loans, you know, but it doesn't matter the reason why they're moving anywhere or if they're all moving in this area. It doesn't matter. What determines the market value is whatever someone's willing to pay and the seller's willing to accept. You know? So if you bought a house in this neighborhood for $35,000 or $45,000, and now they're going for 600 and something, good for you.
Yep.
All right. I got this last year. Was it early? No, this was last year. This was mid to late last year. I got this off of the Varney and Company business program on the Fox Business Channel, where these guys were talking about affordability. If you retire with $1 million, how long do you think you can live in New Jersey with $1 million in your retirement plan?
Is your house paid off?
Well, it doesn't matter if it's paid off or if you're renting. You know, how long do you think you could live with $1 million retirement?
3 years.
Did you say
3
3?
years?
Yeah.
It depends on what city. I would say
How
like
much you making now?
15, maybe. 15. Yeah, maybe 15.
And what age you planning on retiring at?
Who, me?
Yeah.
Depends on how this real estate thing goes.
Well, I
But
mean,
before 85, that's for sure. I'd like to live to be 100, and I need more than, yeah.
yeah, I mean, most people, you know, reach retirement age is about 65, right? Unless you plan on
Yeah.
working as long as you can. If you retire at 65, what is that going to be? 75, 80. So it'll only pay you if you live for 15, if it covers you for 15 years, that's until you turn 80.
That's not enough.
So then you should lower your life expectancy hopes, because
Or
you'll be scraping by and to get by there. So check out this news report. It shows you what are the most expensive and what are the most affordable states to retire in, based on $1 million retirement savings.
The report, by the way, noted that even with $1 million in retirement savings, the average person would only be able to cover about 14 years of expenses in New York City, and I'm not sure it would go that far. New Jersey came in 49th in affordability, followed by Vermont, Massachusetts, Maryland, Washington, Connecticut, Maine, Illinois, and Oregon. California not in there, making up the bottom 10. Okay, let's get to the other side of the story. Where's the most affordable place? Alabama, number 1, as the most affordable state to retire in, followed by Tennessee, West Virginia, South Carolina, Wyoming, Delaware, Georgia, Arkansas, Florida, and Mississippi. In other words, the South. All right, Stu, there you go. New York, though, not very affordable, apparently.
That was a very nice summary. In other words, the South.
Okay.
The
So
report by
just some things to think about. You know, we are all gonna want to retire someday. If you haven't thought about it, I know some people they don't have wills because you think you're gonna live forever, but you know you're gonna get old and you're not gonna want to work the rest of your life either. So you should also start thinking about retirement and socking away some money, even if it's just a little money here and there. That's a good thing. Now, you're only allowed to put a certain percentage of your income in retirement plans that you could take out of your income and put directly into retirement plans to avoid that money being taxed, right? You guys aware of that? If you have a retirement 401k or whatever set up for yourselves, you could have that money directly taken out of your pay. So that money is taken out before it's taxed. It's never taxed, right? Which that's a good thing. You could sock it in your savings towards retirement, right? The tax will be taken out when you're of retirement age, which there's some new interesting things on that. President Trump has just recently said that he is going to raise the amount. Actually, he already signed it, I think, into law. He raised the amount that you can, starting in January, you raise the amount that you could take out of your pay, pre-tax dollars, to put into your retirement plan. And I forget the amount it was, but it was a significant amount that you're allowed to take out of your pay and put in your retirement plan. And he's working on something else, but he's having a tougher time because he cannot just do this on his own. He needs Congress to do it. And you know how Congress doesn't want him to succeed in any way, shape, or form. So he's having a tough time fighting them. But he's trying to pass a law so that your retirement income cannot be taxed. So when you take out that money of your retirement age, you get your Social Security check, they take taxes out of that. You shouldn't be taxing. You shouldn't be taxing that income on seniors. You tax that income. That's much more that needs to be subsidized by the federal government for just regular expenses they need to live. So that would be pretty cool if he could get that passed. But I don't know if his opponents will allow him to reach that level of success and be able to claim that, because I don't think his opposition will ever get elected again if he's so successful with all these things that he's passing to actually help people. I hope he is, but I mean, these are pretty good ideas. Coming January 1st, no tax on tips, right? People that work in the industries, they get tips. No tax on tips. No tax on what the hell was it? No tax on tips.
Was it overtime?
No tax on overtime. And I think actually the other thing was for the no tax. Was it no tax on Social Security? Oh, no tax on Social Security payments. That's different than your retirement payout. So yeah, those three things coming in January: no tax on tips, no tax on overtime, and no tax on your Social Security. That's pretty damn. I think they got the Social Security passed. Let me check. Let's Google it. Hey Google, coming in January, is there no tax on Social Security?
No, that's not correct. Social Security.
No.
Coming in January 2026. Social Security benefits and supplemental.
Okay, so they did not allow him to do no tax totally on Social Security. For some people, they'll have. For some people, there will be no tax on Social Security, but it depends on how much Social Security benefits they're getting. Okay. So no deduction on temporary, and will phase out on income above 75,000 for single filers. Okay. So basically, technically, you can't say that there's no tax on Social Security because those who are making over $75,000 a year, if they're single, or $150,000 a year if they're married, they'll still have some amount of tax. Let me see. The new law provides an additional $6,000 deduction for individuals, $12,000 for married couples age 65 or older. All right, so I guess it's tiered. So you can't technically just say they'll tell you it's wrong if you say no tax on Social Security. Because it's not completely eliminated for everybody. All right. And then what was that other thing I was talking about? The no
tax on tips?
No, not the no tax on tips, or the other thing.
Overtime.
Was it over? No, not the. No, it wasn't about the no tax on those items. It's for something else. Shoot. I'll remember. I'm not going to waste your time on it. I'll remember later. Let's do this last math problem here, or let's do this math problem and then we'll break for lunch. Or do you want to break for lunch first and then come back and do math? What do you want to do?
Let's get it done.
All right. Well, there's more math after this, but
Oh, then never mind.
this is the first one. Oh, never mind. Okay. So, all right. So then we'll pause it and we'll break for lunch here. All right. So let's now get into the math here. How to calculate your monthly payments. Okay. We got that formula right here. You take the loan amount per $1,000 borrowed. You times it by the factor using that mortgage factor chart on page 273. How do you calculate monthly interest? Here's the formula for that. Loan amount times the interest rate is the annual interest. Divide that by 12 and you get your monthly interest. And so how do you calculate how much of your monthly mortgage payment goes towards paying down the amount you borrowed? It's PI minus I equals P. The monthly mortgage payment minus the monthly interest payment equals the monthly principal pay down. So here's a question. You got a $400,000 loan for 30 years at 5%. What is the factor? Using the factor chart on 273. What's the factor for that?
The 5.37.
Yep, 5.37. So how much is the monthly mortgage payment and how much of that goes towards paying down the principal? You got all the formulas up here at top. I'm giving them to you. They're right here at top. You could use that as a reference. I want you guys to figure it out and then send it to me in the chat window. How much is the monthly mortgage payment? And to figure that out, we just use the factor. Remember, and it's per $1,000. And you already got the factor here, 5.37, right? You already figured it out. So if you got a loan amount of 400,000, remember this is per $1,000. So what is the mortgage payment there? The monthly mortgage payment on a $400,000 loan. And then how much of that goes towards paying down what you owe? Or so how much of that monthly mortgage payment goes towards the principal? I'll give you guys a minute to work on that. Remember, you got the formulas right on screen to show you how to solve it. So you all should have the monthly mortgage payment. What's needed to figure out the monthly mortgage payment?
It's the interest rate, which is the 5.37.
No, I'm talking about the monthly mortgage payment. What's your total monthly mortgage payment, principal and interest, the PI?
2148.
That's what I have.
Well, how do you figure it out?
Oh, so you the 5.37 times 400 because the loan is 400,000
And it's per $1,000 borrowed.
per $1,000.
Like
Right.
up here, how to calculate the monthly mortgage payment.
So I have that, and now loan amount 400. Okay. Times the interest rate.
Okay, so how do you figure out how much of your monthly payment goes towards the principal? If we look down here at the bottom, monthly mortgage payment, the PI, minus the monthly interest equals the P. So
Yeah.
how do we calculate the interest? Loan amount times the interest rate equals annual interest, because interest is calculated annually, and then you divide it by 12.
That makes sense.
So the question has the answer right in it. 400,000 times 5%. Then you got to divide that by 12. And then you subtract that from the PI.
Divide by 12. Principal. No, that's PI.
So what is the annual interest? The annual interest.
20,000.
So you take 400,000 times 5%. And that gives you, what did you say, 20,000?
Yeah.
Then you have to divide that by 12 to get the monthly mortgage payment, the
And that's
monthly interest.
1666, 66.
Yeah, I got that.
And then you subtract that from the 2148, you get 482.
20. So you take your PI and you subtract the I to be left with the P. That's the formula, right? And what did everybody get?
481. We'll round it up, the 1667. 482.
482.
Okay.
All right.
Okay.
So there you go. Your monthly mortgage payment of $2,148, only $482 went to pay down what you owe. The
Got
rest
it.
was rent. The rest was the rent that you paid for borrowing someone else's money.
Can I ask you to go back to the factor quickly? Because I know we're using this mortgage factor chart. But in this question, we kind of backed into the interest rate, it looks like.
Well, the interest rate was right in the question.
Oh no, interest rate's 5%. Oh, then never mind. I know how to do it then. Okay, got it. I need these freaking glasses.
See, that's
Just
the
go
thing.
down
You
from
got
the left to the over to the right.
When you
Okay.
read the question, some of these things can be figured out just by the information that's given in the question
Yeah.
itself.
It's there. I see it. Okay.
The factor you need to find out by looking at the chart.
Okay. On
But
273.
the rest is there in the question.
Got it. Okay.
So you guys may want to, snap a picture of the top part of this chart, which basically is the formulas you need for figuring out most of this stuff.
Yeah.
How to calculate the monthly payment, how to calculate the monthly interest, how to calculate your monthly principal paid. Okay, so this tells you how to do it, and we just did a little walkthrough on the sample and the example here. So you guys may want to snap a picture, get a screenshot, do whatever it is that you do there on your end. All right. Here's another one. Using the same problem, we're gonna calculate what your pity payment is.
Loan amount per
If your taxes are 9,000 a year and a property insurance is 900. Here, just to refresh you from the previous screen, your PI was 2148. So if your taxes are 9,000 and your property insurance is 900 a year, what is your monthly pity payment? For that, we need to figure out what our monthly TI is. TI stands for what?
Taxes and insurance.
Okay. So all you got to do is add up your annual taxes, annual insurance, divide it by 12, and then add it up.
Calculator. All right. I have 2973.
Yep, that's what I got.
So you take your annual taxes, 9,000, plus the annual insurance of 900. That gives you 9,900. Divided by 12. 825 for taxes and insurance. Now you add your TI to your PI, you shake it all about, and you get your PI TI of 2973. Everybody good on that?
Yep.
I'll give you a second if you want to snap a picture of this.
Got it.
Okay. All right. So now let's go over this. This is often a state exam question. How to compare two loans. Now that I taught you how to calculate what your monthly mortgage payment is, how to figure out how much of it goes towards the principal, how to calculate interest. If the question is, how much would you save on interest over the life of a loan on a 25-year loan versus a 30-year loan, if the loan amount is $300,000 and the interest rate is 5%? Do not do nothing yet. Explain to me what you would do.
I will get the factor on each year, the 25 and the 30 first.
Okay. Yep. And then what are you going to do with
that? Multiply by the 300,000 or 300.
Or 300. Yeah, the 300. Okay. And that gives you the monthly mortgage payment, right? For each loan. Now what do you do?
Now you find the interest rate.
Well, the interest rate's there in the question, 5%. But we don't need to know that. You already figured out the factor using that interest rate. Okay. So the factor is what you needed, the interest rate and the number of years in order to figure out the factor. So you got the factor for each one and you multiplied it by 300 because it's based your monthly mortgage payment is calculated based on the factor times the number of thousands that you borrowed. So if it's 300,000, that's 300 times the factor for each one. That gives you the monthly mortgage payment for a 25-year loan and the 30-year loan. Now, what do you do with that?
Now you multiply the mortgage payment times the rate.
No. What would
The
that do?
answer that will give you.
No, no. You're trying to figure out how much you would save on interest over the life of the loan. It's a lot simpler than this. I just want to see if you guys can figure it out. It's a lot simpler than this. Don't overthink this.
So just get the difference between the two. So you have 1611 for the 300,000. I'm sorry, for the 30-year versus 1462.50 for the 25-year. You multiply that by 12 and then subtract it from each other.
I think you subtract the mortgage payment, which is the 25-year versus 30. You subtract it and you will see how much you're saving between both.
No.
Sure how that
Look, the question, let's read the question again. It says, how much would you save on interest over the entire life of the loan for a 25-year loan versus a 30-year loan? So how do you figure out the interest over the entire life of the loan? If you got the payment, so far you guys are right, okay? You figured out that you got to figure out what the monthly mortgage payment is, which includes both principal and interest. Is your monthly mortgage payment, is your PI. So you figured out what your monthly mortgage payment for PI is for the 25 and the 30-year loan. That's the first step. You got that part right. Now you guys are getting a little confused. Maybe you're overthinking it a little bit.
Now we got to find the interest.
How much would you pay over the life of the loan?
Loan amount.
Are we multiplying these by 30 and 25? No, that'll take us back to where we started.
No, you're multiplying
No, but you're on the right track.
You're multiplying the 5%, which is the interest rate, with the loan amount.
You guys are way overthinking it.
Let me try this. Should we subtract the 17,550 minus 16,110 and multiply that answer by 5?
Nope.
So I'm gonna wave the flag.
Okay, here.
I don't know. What's the answer? Minus 16.
What's your monthly mortgage payment on a 25-year loan? Let's start off with one at a time.
I got 1462.50.
Hold on. Let me open up the screen on a separate window for myself that you can't see. Okay. What did you get for your monthly mortgage payment for the 25-year loan?
I got 1462.50.
What's the factor on a 25-year loan at 5% interest?
585.
Sorry, 585.
So what's 5.85 times 300? Because it's per $1,000 borrowed.
No, isn't it 250?
Where'd you get 250?
Because it's a 25-year loan.
Yeah, but the loan amount is 300,000.
Okay.
It's per $1,000 borrowed.
Yep.
It's 1755.
Correct. That's your monthly mortgage payment for the 25-year loan. So I want you to make 2 columns on your scrap piece of paper. One for 25-year loan, one for the 30-year loan.
Yep, got that already.
So what's the factor on the 30-year loan at 5%?
1611.
The factor.
On a 30-year?
On a 30-year loan.
5.37.
5.37. So now what's the monthly mortgage payment, John?
1611.
1611. So 300 times 5.37. That's 1611. So your monthly mortgage payment including PI, principal and interest, for a 30-year loan is 1611, and for the 25-year loan it's 1755, right? That
Yep.
You got that in your columns,
Yes, sir.
right? Okay.
Yes.
Now, how do you calculate how much you pay in total for each loan? Forget about the interest. How much are you paying in total? If you were to pay off that mortgage, that 25-year loan, let's start with that one.
You
How-
multiply
it's
by
by
12.
it's by the month, so it will be 30-year loan has, you say, about 360 months about
Yeah.
a payment.
Correct.
So
So in a 30-year loan, it's 30 years times 12 months in a year. That's 360 months. And how many months are there in a 25-year loan? 25 times 12. 300.
300.
Now what do you do with that information? You're hot there, Kev. You're onto something. Remember, the question at this point was, how much are you going to pay over the entire life of the loan?
So you multiply the 5% times.
Forget about percent. Forget about percentage. What are you trying to do with the percentage?
We're trying to find the interest rate.
Well, the interest rate's built into your monthly payment. Remember, your monthly mortgage payment consists of what? It's PI. What does PI stand for? Principal
and interest.
So you already figured in the interest. You're just trying to figure out now, what's the total amount that you pay, principal and interest, over the life of the loan? Kevin said something about, well, we need to find out how many, it goes on the number of payments. So how many payments are there in the life of the loan for a 25 and a 30-year? We just figured out.
If you had 360 months on a 30-year.
Okay.
So that's about 360 payments.
So that's 360 payments. So what are you going to do with that information?
Is it divided by the 300?
Multiply by 1611?
No.
Okay.
No.
Yeah. Your monthly mortgage payment. I asked you, how much are you going to pay over the entire life of the loan?
So it's 579,960.
You take your monthly mortgage payment, times it by the number of payments over the life of the loan. That's 360. And 300 for a 25-year loan.
Got it.
So for a 30-year loan, you would have paid 579,960.
All right. And 526,500. So the
There you
difference
go,
on
right
those.
Okay. Wait, hold on a second. That's Jaron, that's a shortcut. Don't take the shortcut. It gives you the right answer, but it's a shortcut.
Okay.
Don't do that.
Okay.
I want to know how much you pay in interest on each loan. So if you know how much you're going to pay over the entire life of the loan, the principal and interest, we already figured that out. The PI, those numbers that you got, the 526,500 and the 579,960. That's how much you paid over the life of the loan, right? For a 25-year loan and 30-year loan. So that's your PI. How do you figure out the I? Think about it. Forget about the number. Listen to the formula.
You subtract the loan amount.
If you have a PI, forget about numbers. Pay attention to me here. PI. I want you to figure out what the I is. So if you have PI, what do we got to do to figure out the I?
Subtract the principal.
Subtract the P, the principal. Subtract the P from the, And what is the principal? It's the amount you borrowed. And what's the amount you borrowed? Is it in the question itself?
Yeah, it's 300,000.
300,000.
And then that should, if you subtract that, then what should you be left with?
279,960 for the 30-year.
Well, once again, I care less about the numbers. I care that you know what those things are. The PI, the I. I want you to know what the formula is. So PI is principal and interest. You calculated that by taking the monthly mortgage payment and timesing it by the number of payments over the life of the loan. Then you subtracted the P, the principal, the amount you borrowed, from the PI will give you the I, how much interest you paid over the life of the loan. Okay. I want you to rationalize what it is you're doing, because the numbers you guys aren't going to remember. You're going to type them in a calculator. They're going to be different numbers. I want you to know the formula, what exactly it is you're doing. PI minus P equals the I. And how do we figure out the PI? We use the mortgage factor chart, right?
Yeah.
And how do we figure out the lifetime PI then?
Times the number of payments over a lifetime.
And how do we figure that out if it's a 25-year loan? How many months in a year?
12 months.
How many months?
Yep.
12 months times the number of years, right?
Got it.
I want to keep it simple.
Guys. We overthought it.
Yeah, and then,
it's easier than we made it. Got it.
Okay.
Yeah, I think we weren't overthinking this, but
we were,
Because listen, I already have this all figured out, and I wanted you just to look at the question and try to rationalize it, really think about it, for a second. I put a little stress on you. I put you on a spot, but you're going to be stressed on the exam anyway. So I want to put you on that spot, get used to it. So here, this is what I did. You needed this factor chart to figure out the factors for the 25-year and 30-year loan, which you guys know how to read the chart, obviously now, right? That's the easy part, right?
Yeah.
Okay, so you guys got that. This is nothing. You got it.
Got it.
So now this is the breakdown side by side. Here's the question. Once again, at the top, I wrote the question for you, and I broke it down side by side. First, we looked up the factor for each loan. Then we figured out how much. I should have put these in the opposite order, though. Then we figured out what the monthly payment was for each loan, right? Then we figured out how many months were there over the life of the loan. 25 years times 12 months is 300 months. 30-year loan, 30 years times 12 months is 360 months. So now you just take the monthly mortgage payment and times it by the number of months in the life of a 25-year loan is 300. And take the monthly mortgage payment in the 30-year loan, 1611, times the 360 months, 360 payments in the 30-year loan, gave you that 579,960. Then we just subtract those from the amount you borrowed, the P. Take the PI, the total, minus the P equals the I, right? See, at this point, Jaron, you were trying to do 579,960 minus 526,500. And yeah, that will work. That will give you the answer, but it's a shortcut. You won't know how much you paid in interest on each loan. See, here, doing it like this with this step, now you know how much you paid in interest for each loan. And holy moly, I want to be a lender.
like I got it in a different way, but I got the same answer though.
What did you do for your way?
So basically, if you multiply like the month by the what's that called, the PI?
The monthly mortgage payment, that's the PI.
So if you do both, and then you get the answer by the 579,960, 526, 500. And then
okay, so you did the 1611 times the number of months.
Yeah, so then if you take the 526, 500 minus I mean, sorry, the 579, 960 minus the 526, 500, it will give you the same answer.
At that stage too. Yeah, because it tells you the difference. Yeah, that's the same thing that Jaren was doing. And I told her, I was like, nope, don't do that. That's a shortcut. It'll give you the difference. It'll give you the difference, but you won't know how much you paid in total interest for each loan. You follow?
Yeah, that's why
I wanted you to see that. I want you to do this part to see that. And it's not hard. All you got to do is look at how much did you borrow? If you subtract the amount you borrowed, the principal, from the principal and interest, you'll be left with the interest. Okay. That was the hard part you guys were trying to figure out. It's not that hard.
Right. Yeah, we made it harder than it needed to
be. The two hard parts, well, the first hard part, which was the key to it, was figuring out that when you get your monthly mortgage payment, you got to figure out how many payments there are in the life of the loan and just multiply it by that. That was the key to figuring out this. And then this other part was just a little technicality. Like you guys got to it by cheating, just subtracting one from the other. You're using a shortcut. Okay, you aren't cheating. You're using a shortcut.
There you go.
But that doesn't tell you how much in interest you paid for each loan. See, this one does. And then you subtract the interest from one loan to the other, and it gives you that figure, $53,460.
Got it. I have a question. I don't know why I used to think that mortgage was all four of those letters, PITI, the taxes and insurance as well.
Because a lot of banks and lenders want you to include the property taxes and insurance payment in there, because
but you don't have to.
The insurance insures their collateral, which is the property, in case something happens. And the taxes, if you don't pay them, there could be a tax foreclosure sale, which completely wipes out the lender's interest. So they want you to include those two very important payments in the mortgage so they could be sure that they're getting paid. Because otherwise, your lender doesn't know if they're being paid or not. That's why they include it in it, but it doesn't need to be included in your monthly mortgage payment. Okay, so they want you to include it so much. They want you to include it so much in your monthly mortgage payment so that they're aware that's what's going on, that they'll incentivize you by giving you an 1/8 of a point discount on your interest rate that you pay. So that if you agree to include those in your monthly mortgage payment.
Got it.
So that they could be aware, they could see you making the payments.
Got it. Okay.
Because you're rendering the payment to them, and then they're rendering the payment to your city and your lender, your insurance company.
Got it. That makes sense. That's helpful. Thank you.
Okay. Everybody get a screenshot of this that wanted one?
Yes.
All right. You do get a question exactly like this on your state exam. They'll always give you a question comparing two loans, how much you would save on interest over the life of the loan. So you will get a question on the state exam like this. Now that you know how to solve it, is it difficult to solve?
No.
No, you just got to remember. Don't forget it. You got to study this.
You got to remember how to put everything.
But nothing here was so crazy hard, was it? Once you knew what to do, it was like boom, 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 right?
Right.
So don't get scared about math. This isn't as hard as it seems. You just need to walk yourself through the steps. What is it that I need to do next? You see what I kept doing in order to get to the answer? I said, what is it next that I need to do? I kept asking a question about the question, and it walked me through what I needed to do, what you needed to do, right? Okay. Now that we got that, here's some more example problems you guys can do on your own that are on the slideshows. I already got them worked out if you wanted to. If you want to snap a picture instead of going to the slideshow later, go ahead. Snap a picture of it and figure it out later. You could cover up the answers and then work it out. There's one. And at the end of each chapter, you got sample questions like this. And in a shared Google Drive, I got a whole list of Word documents full of questions for each chapter. that you can use as practice and study exams. Here's another one. And here's that T formula. Remember this one? Small number up top, large number on one side, the rate on the other. It's used to figure out commission problems, cap rates, and things of that nature. Here's all those problems that it could be used to figure out. All you got to do is, if you're trying to figure out commissions, take whatever the number is here for one, the information from one here, and the information from one there. You need to have all two of the three figures to figure out the missing component. So we're going to use those T formula now.
Okay.
Now, I got something already filled in here. I got to figure out how to not have it filled out. Okay, so I could figure that out and work it out later. Actually, let me see if I can even do that right now. Can I? Can I? Transitions, animations, no transitions. And yeah, we'll bring that one in on click. And I just got to change the order. Boom, boom. There we go. Ah, that didn't work. I only wanted to include part. Oh, that's why I got all the elements locked together. Let me ungroup them. And now I can just select one element. And then change the order. There we go. I think I fixed it. So now the slide will work properly. So here we go. If you have a question like this is kind of tough. This is kind of tricky. It's tricky. It's not tough. It's tricky. If the monthly interest payment at 5% is $1,250 a month, what is the principal amount of the loan? Well, if the monthly interest payment at a 5% is $1,250, what is the principal amount of the loan? Well, all we got to do is reverse engineer the math here. How is interest calculated? How do I keep saying interest is calculated? I keep saying on an annual basis, right? You calculate interest annually. They're giving you a monthly figure.
You multiply that by 12.
So you multiply this $1,250 monthly figure by 12. That'll give you the annual figure.
$15,000.
And it is 15,000. And I still got to refix the slide because I thought I got it all fixed up, but I really didn't because it needs to go after.
Oh, I got it. Hold on.
There we go. Now I got it, I think. Okay. So we take the $1,250 monthly interest payment here. And times it by 12 to give us $15,000 in annual interest. Now we could plug it into our T formula. The animation's still not quite working right. And then the next step is that. Okay, here, let me try to work this out here. This should be at 3, and this should be at 3. Two, 3, 4. All right. Let's try this one more time. Sorry, I'm trying to fix the slide here while I'm working with you guys. Okay, so we figured out that you got to calculate that times 12 gives you 15. There we go. Now I got it in the right order. It's working now. And then we could plug that in up there at the top, and then 15,000 divided by 5% gives you $300,000. That's how we figured this out. So this was the question. If the monthly interest payment, let's go back to the beginning here. If the monthly interest payment at 5% is $1,250 a month, what is the principal amount of the loan? Remember, monthly interest times 12 months to get the annual interest, divided interest percentage to get the loan amount. So here is the monthly payment, and here is the annual percentage rate of 5%. So if the monthly is $1,250, we got to multiply that by 12 months to figure out the annual figure. Now the annual interest goes up here, then you divide it by 5% to get the loan amount. Of 300,000. That's the key. You could get something tricky. This is a bit tricky though. You know, for that you need to remember everything is interest is calculated on an annual basis, and here they just gave you a monthly figure. So this one's a little tricky, but not if you know what you're looking for. Not if you know that interest is calculated annually. So if they give you a monthly payment, you're like, yeah, but it's calculated annually. If you ask yourself a question about the question, and then you could figure out what the annual is times 12, and then figure out the rest using the T formula. Okay, so everybody got a screenshot of this that wanted one?
Yes.
Okay. So once again, here is the T formula and all the different problems that it can be used to figure out. All right, let's move on from the math. Let's graduate to the Your Home Loan Toolkit. So HUD had always been the one that investigates and manages mortgages and, you know, fraud and all that stuff. HUD is the one that puts the rules into place that the lenders need to follow. However, during President Obama's presidency, once again, we're going to see how politics plays a role on things here. He created a new agency called the CFPB. That's the Consumer Financial Protection Bureau. And they were there to, you know, I don't know why he created it, really, you know, because HUD already had a lot of these duties. So the CFPB, though, they're there to regulate, I guess, and to make sure that lenders, whether it's credit cards or student loans or mortgages, let's focus on the mortgage part of it, for the mortgage lending. They were there to make sure that the lenders follow the rules, and they also have the documents. They took over to try to justify their existence as far as the mortgage lending goes. They just took over a lot of the forms that HUD already created, because HUD was already doing this stuff. So they took over a lot of the rules and the forms that HUD created. Some of them they just renamed. Some of them they merged and then gave it a new name. So you now have to know what the original document was that HUD had, what its purpose was, and what it was renamed to, what the new document is called, and when it needs to be given to the consumer. So you need to know the document's name, when it needs to be given, and what document did it replace that HUD originally had. Okay. You could say, thank you, President Obama, for like making me have to learn an extra thing here now. How come they don't, why do they want us still to know the old document's name? We don't use them no more. Because on certain types of loans that don't require the new documents, we could still use the older ones. Why would we want to use the older ones instead of just the newer ones? Because they were easier to use. All right, so what is the Your Home Loan Toolkit? It's a step-by-step guide explaining how to shop for and compare loan costs. It lets the consumer understand about what are the pitfalls and the charges by the lender and how to shop and compare loans. The lenders are required by the CFPB, the Consumer Financial Protection Bureau, to provide the toolkit to the borrowers within 3 business days of the completed loan application. And when is a loan application considered complete? When the aliens have landed. I'm serious. When all the information of aliens, that's an acronym, when all the information from aliens has been provided by the consumer to the lender, is when the loan application is considered complete. So aliens is an acronym that stands for A is the address of the property being purchased, when they provided that information. When they provided the loan amount that they're requesting, the income of all the borrowers, the estimated value of the property, the names of all the borrowers, and their social security numbers. Look at that. It spells aliens, right? So when aliens have landed, the loan application is considered complete. And now the lender's required to give certain disclosures to the consumer. They're required to provide the Your Home Loan Toolkit within 3 business days. So they got to put it in the mail within 3 business days of the borrower completing the loan application, supplying all this information. And they're also required to send out something called the loan estimate, but we didn't get to that yet. Okay. Now, a lot of times I'm giving you guys links and additional resources. A lot of this stuff I got on slideshows. If you were to put it as information on your own personal real estate website, that's original content. You're educating the consumer. It's all real estate related. This will bring more traffic to your websites and generate more leads. When people search for homes, they can search for them through your websites. But you need to drive people to the websites. You can't just have a search for homes. you should also have a lot of information about real estate, a blog, for instance, articles. You guys can make articles explaining this stuff like I'm teaching it to you. You can make an explanation like that to the consumer. And then that's content, original content, and the search engines rank you higher. Just giving you extra tips here. Okay. So anyway, here are 3 great resources for you. Let me copy them and paste them and give them to you, even though they're in the class links Word document like all the others. The CFPB website has the toolkit. That's the link to it right here. The New Jersey Real Estate Commission has a home buyer's guide. Actually, it's not the Real Estate Commission. It's the DOBI. DOBI. I'll put / New Jersey Rec. DOBI. What does that stand for? Department of Banking and Insurance. The Real Estate Commission is a division of the Department of Banking and Insurance, and they put together a great guide for home buyers. And when we open this up, you guys are going to see that a lot of the stuff I'm teaching you right now about these mortgages and stuff, all in that guide. And they give pretty damn good explanations on them. So if you were to actually read this guide, it's actually a pretty good study notes for you too. And then there's also a guide from the NJHMFA. That stands for the New Jersey Housing Mortgage and Finance Agency. They also put together, now this one's a little bit more modern, updated, but this one still has a lot more detail. So these are great guides for shopping for homes. Here, let me show you the example of the one from the NJHMFA, which they recently changed the link and relocated it on their website. I had to hunt it down and track it. And thanks to my old programming skills, I was able to find it. And here's the link for you to this guide, which, let's look at the table of contents, what it teaches you. Is owning a home right for you? That's a good question to ask. Not everybody is ready to be a homeowner. The cost of the ownership, home buyer counseling, getting pre-qualified or pre-approved for a mortgage, launching your home search before making an offer, obtaining a mortgage, the home inspection, preparing for closing, what happens during closing. And then they give you important tools and resources, frequently asked questions, a glossary, housing expense calculator, question and answer notes. All of that is here. And let's see. So where's that calculator or calculators? Page 33. Let's try to scroll down here, get to 33. There you go. Here's the calculator. You could actually, can you click on this? You should be able to. Well, when you download it, you can. I'm working on it within the browser. You could actually plug in the numbers here and it'll do the math for you. All right. So let me share these resources with you guys for all 3 of these. Oh, you guys weren't even seeing it. Sorry. The housing expense calculator. Remember, if I'm talking about something and it ain't matching with jiving what you're seeing on screen, you gotta let me know. Okay, so this is that home buyer's guide from the NJHMFA. This is also the same group that makes interest-free loans for water filtration systems, water treatment systems available for people who are getting well water in their house. They also provide loans for first-time home buyers and such. This is a governmental agency. They don't actually lend the money. They have local lenders lend the money using their programs that they insure or guarantee, kind of like the FHA and the VA. But this is a New Jersey agency. Now take a look at this one. I told you is really good. The New Jersey DOBI Rec Home Buyer's Guide. Let's click on that. Scroll to the beginning here. Everything you wanted to know about buying a home. You could even kind of rewrite this book into your own book and guide for the consumer. If you took the time to do that, you know. And it teaches the buyer how to, well, first of all, look, they give you the link directly to the Department of Banking and Insurance's website, which regulates all the lenders. They have getting started. Why buy a home? Why not buy a home? Assessing your financial situation. Review your credit history and what's the score. Going shopping. Shopping for a loan, shopping for a real estate agent, and then finding your home. How to make an offer and put it in writing. Yada, yada, yada. This is a great little guide here. And I explained to you guys equity before, right?
Yeah.
Appreciation is an increase of value, what the tax advantages are. Offers generally fixed housing expenses, giving you control over the environment. Why not buy a home? Getting started in your home search. The debt to income ratio, understanding that. And understanding qualifying ratios. The DTI 2836, what is that? Well, we're going to go over that in the slideshow. I actually took screenshots from this book to put in the lesson that I teach you because they did such a good job explaining it from this book. You know, talking about down payments. What is PMI? Remember we spoke about it a little while ago. Sharon, you asked me a question about that. PMI. Now this really needs to be updated a little bit though, because President Obama made some changes about this. Interest rates. Rate locks. What's a rate lock?
When they lock in your interest rate for 30 or 60 days. And
yeah, 30, 40, or 60 days.
Yep. 30, 40, or 60
45.
days.
30, 45.
30, 45, or 60.
Yeah.
And if you're going to miss it, then you can pay to extend
Have
it.
an extension, yeah. And you can get a free copy of your credit report from all 3 credit reporting agencies every year from annualcreditreport.com. Did you guys know that?
Yes. Is all of this information in your shared? Oh, sorry, go ahead.
That's all in this booklet, in this one booklet.
Oh, wow.
Yeah.
And this link is in the shared class folder.
It's in the class link Word document, and I just sent it to you guys in the chat window.
Thank you.
And then here's the contact information for all 3 major credit reporting agencies. Understanding what's a good FICO score. Actually, FICO scores, anybody know what the highest FICO credit score is?
800?
No.
I think it's higher.
Here they say they range from 300 to over 800. Anybody know what the highest is?
801.
850. 850. I know it's higher than 801 because do you guys ever check your credit report?
Yeah.
Yeah.
You ever check your credit scores? Anybody got
Absolutely.
Credit Karma? Anybody got a Credit Karma app on your cell phone?
Yep.
If you don't, you should download it. Credit Karma, Karma, Credit Karma. You could subscribe to it and check, and it'll give you updates anytime there's a change in your credit score. And you could check it too. Your credit score, your credit limits. It's not 100% accurate, but it's pretty close because this does not affect your checking it on this app does not affect your credit score. Usually when you run your credit score, it could affect your credit score. So here, I'm opening up my Credit Karma app. Got to use my fingerprint. Man, my credit score went down a little bit. But you guys tell me, what do you think? Am I doing all right?
Damn.
Too shabby.
That's pretty impressive.
Show off.
We need
wait,
to
now
shift
it's-
the focus of the class to figure out how we all get an 816.
Actually, it showed it went down. Now it just popped and it showed that it went up. It's 816. It went up 5 points on one and 6 points on the other today. Well, look at that. That's why it went up as I showed it to you. It just updated. Okay, so 816. That's not a bad credit score. Hey, listen. What is the average? What's average credit score?
What's the average? I would say maybe
They call it prime. No, there's an actual number.
630, I think.
thought it was
620.
650.
Close. It's 620.
620. Okay.
620 is what they call prime. The prime rate, that's the average. Anything below 620 is called subprime. And it's riskier to lend to. And people with scores under 620, they don't get the best credit percentage when credit is offered to them. They're not getting the best rates. If it's under 620, you may be paying a higher interest rate. Even at 620, that's average. You're not getting the best. In order to get the best interest rate for loans that are available, whether it's a car loan or for a house, you need to be in the top tier, and top tier used to be 720. 720 is great, but 740 and above, that's top tier. You're going to always get the best interest rate if you're at 740 or above. Okay. So I worked hard at this. You know what I do? I don't charge anything unless I have the money to pay it off. And I use my credit, because if you don't use your credit, it doesn't help you. So whenever I get gas, even if I got money in my pocket, I charge it and then I pay it at the end of the month. If I buy groceries, I buy them with a credit card and then I pay it off at the end of the month. As long as I got the money, I do not overspend, because if you carry over balances, it's not necessarily a negative thing, but if you carry over a certain percentage of your total available credit into the next month, that could negatively affect you. It starts to affect you when you're around 30% or more. So if you're using 30% of your available credit or more, that starts to negatively affect your score. You should see my credit score when I order books, for the school. I order several, I order at least 30. So I order several cases of books at a time, 30 to 50 on average. So I'm spending thousands of dollars in ordering books. And every time I order books, my credit score takes a dip. And then once I pay it off, it pops back up again. So you got to realize your credit score is all over there. So if you're looking to get a loan to buy a car or something like that, don't go place any of those big orders on your credit card where it's going to take a dip. You're going to have to wait till it rebounds before you go out and get that loan. Otherwise, you're not going to have the best score, right? Anyway, that's just a little for you insider information there. But it's good that you understand how credit works so that you could guide your potential clients in how it works too. Sometimes we get people, they got piss poor credit. They come in, like I remember one guy, he came in, I was so excited just to have a client. So I was running him and his wife around all over the place, his wife and his kid, making a mess of my car and showing them properties all over the place till they finally find the right one, ready to put an offer in. We go back to my office, and that's when I hook them up with a mortgage rep, and they ran their credit. And I seen the credit, and I was like, son of a bitch. I was like, I just wasted so much time with these people. The guy, he had like a 480 credit score. Like, dude, don't you ever pay your bills? That's not even not paying late. That's like not paying your bills. 480 credit score. What are you going to buy with a 480 credit score on credit? Not even a pack of chewing gum. You're not going to get any bubble gum for that. So if people come to you like that, you got to tell them, listen, you need to get your financial house in order before you start searching for a house. Okay. So start paying your bills on time, pay down your debt, your credit score starts improving, then come back and then we'll see what we can do for you. But can people buy a house with credit scores in the 500s?
Yeah.
Yeah, mid to high 500s. You know, you start getting in the low 500s, it's harder to find a lender who's willing to lend the money. Because what is a credit score? What is it a reflection
Of your life, I believe.
of? Well, what specifically about your life? Your health?
Your dependability, I guess.
Show more.
Actually, that does play a role, even though we're not supposed to talk about that stuff. It does, but let's just keep it on the financial aspects. It has to deal with your history of paying your bills on time, of paying your bills and paying them on time, because they also look at if you pay them on time. Okay, so all those play a role. Even how the age of your credit history. Do you have an old line of credit? What's your oldest line of credit that anybody here has? Your oldest, it could be a credit card, cell phone, something that you that you have an account that you pay on credit. What's your oldest line of credit?
I would say I was naive.
9 years.
Over
Okay.
9 years. Gotta be.
I think I have one that's like
if that credit
old.
If that credit card that you have is 9 years old, okay, that's your oldest line of credit, and you get a better credit card, do not cancel that old one.
I do not cancel any credit card. It will affect more than the.
Well, you could cancel credit cards, just don't cancel your oldest line, because your oldest line shows your stability and your length of credit history to the credit reporting agencies. It does play a role. I have an old, I don't even know. I could go through my Credit Karma and take a look, but I have a old line of credit. I don't even use it really, but I try to once in a blue moon just to keep it active. You know, because if you use that old line of credit, it goes towards your stability. You know, that's kind of like how car insurance companies look to see. You ever get car insurance and they ask you if you're single or married or divorced or widowed?
Yep.
You ever wonder what the hell does that make a difference?
Yep.
What does that have to do with my driving record? Has to deal with your stability.
Believe it means you're more stable. Yep.
But a lot of that is just bullshit. Because what do you mean? Because my relationship didn't work out, I'm not the stable one? What if it was her? You know? But okay, well, what about if you were married for years and years and years and your spouse just died? You're a widow now. How does that make me unstable? You know, but they do consider that. Huh?
Maybe you killed her.
Maybe you should be in jail then. You know, but you know, that's a ridiculous thing. Do you know that if you lie to the car insurance company about that, your relationship status, they could, if you file a claim, they could refuse to pay it out and cancel your insurance because you lied about that you're divorced. You said, I'm single. I mean, technically, I am single if I'm divorced, right? No, you were once married, it didn't work out, and now you're single again. That works against you. But if you don't report it and you just say that you're single, that works against you because they could cancel your claim, even if you've been paying the insurance. That blows my mind.
What about if you don't answer the question at all?
They don't give you a quote.
It's again policy not to give me a quote because I don't answer one of your questions.
Yeah, isn't that stupid?
It is.
Listen, I just had to shop around for insurance because my insurance company blasted my insurance through the roof, and I had to answer these questions. And I started doing some research because it really bothered me. I was like, what business is it of yours, my relationship?
Something that New Jersey has is it if you have an accident or anything like that, and it's not even your fault, you have to report it.
Yeah. Well,
It's crazy.
You know what? It gets reported on you anyway.
Yeah, but they call you, and your insurance had to call you and find out who fault was that, and you gotta prove that it wasn't your fault, and it's a bunch of paperwork.
You get into an accident, police respond. If police respond, they make a report. If you got points because you violated your driving, you have license points that go on your license. There's also a separate background system you'll never see called insurance points. The insurance company is giving you points as well that would count against you. What kind of BS is that? But it happens in the background. How about this? You want to know another factor that affects you? Are you a man or are you a woman? That affects you, which blows my mind, especially since New Jersey is one of these states that if you say you're a woman, you are a woman. Right? So what? You count against me insurance points against me because I'm a man? Because women tend to drive more conservatively and to be more responsible? I could show you some reckless driving women. I could tell you, boy. Yeah. But yeah, that's the way that they think, because on average, women are more responsible and women are drivers. They're more careful, you know. Okay, so what if I'm a trans woman? Still a woman, right? Do I get treated the same? Yeah, I'm going way off topic now. Let's get back to this stuff. Because this is just stuff that's irritating, but it does affect you in everyday life. It blows my mind. Okay, so I just shared with you guys these 3 links here for these home shopping guides. Great stuff. But what does the lender have to give you within 3 days of your completed loan application? The Your Home Loan Toolkit, showing you how to shop for and compare loans. And when is a loan application considered complete?
When the aliens have landed.
When the aliens have landed, when you provided all the information of aliens. There you go. So I got the page cross references here. This stuff is found on page 294, the aliens. This is on page 275. So the home loan toolkit includes things like how to determine loan affordability, how credit scores affect the availability of mortgage money, how to choose the best loan and down payment, understanding the trade-off between points and interest rates, the value of shopping for several lenders, how to avoid the pitfalls and problems. Loan estimate is the LE. That's given to you within 3 days of your completed loan application as well. And the closing disclosure, the CD. So we're going to talk about the LE on page 294 and 299. And on the closing disclosure, that's going to be discussed on 299, 389, and 394. Okay. The Your Home Loan Toolkit, let's just highlight. Lenders are obligated to provide the booklet to borrowers within 3 business days of their completed loan application. The funny part is what they write right after this. No one's actually responsible for explaining the contents of the booklet. So lenders are required to give it to the consumer within 3 business days, and if they don't, they could be fined. But yet nobody's required to even go over it with you. They say real estate licensees can provide and discuss the booklet with their buyers as soon as practical, even before the buyers consult the lender. Well, it is true. You could talk to them, give them a little guidance about how to compare loans, how to shop for loans, loan affordability and stuff. And here's the links where you could actually download it in English and Spanish. All right, now let's get into types of loans. This is the stuff at the bottom of page 275. Conventional loans. sometimes referred to as portfolio loans. You could get them from portfolio lenders, sometimes called conventional lenders, who lend their own money. They don't plan on reselling your loan. They keep them in their own investment portfolio, thus the name portfolio lender or portfolio loan. These loans are, we already seen how much money you could make off of lending, right? So if you kept that loan in your own investment portfolio for the long term, you could make a lot of money. So conventional or portfolio lenders write conventional or portfolio loans. Those terms are used interchangeably. These loans are directly between the lender and the borrower with no third-party involvement or influence from outside sources who may set guidelines for the types of loans that they're willing to buy. Most lenders originate loans with the intent on reselling them to get the money back so that they can lend it again and then get the money back, plus some interest, plus maybe get paid a servicing fee to do the continuing collections and accounting for the investor that bought the loan that they originated. So that's how your local banks make money. You guys follow what I just explained on that? You go to your local bank to get a loan. Their job is to see if you qualify for that loan. We call this loan origination, where they then write the loan and lend you the money. But they'll only lend you that money if you meet certain loan qualifications. What are these arbitrary qualifications you need to meet in order for them to lend you money? Well, they're the specifications of some third-party investor that they're eventually going to sell that loan to. That investor says, hey, listen, if the borrower you lend the money to meets these qualifications and the property they're buying meets these qualifications, lend them the money, and then we'll buy that loan from you. So those lending guidelines that your local bank has, they don't make up those guidelines. Those guidelines are based off of a third party for the types of loans they're willing to buy. So when your bank writes a loan to you to buy a house, they know they already got somebody lined up who's willing to buy it, because their loan guidelines that say that we'll lend you this money if you meet all these guidelines are the same guidelines for the types of loans that this investor will buy. So they know right off the bat, we lend this person meets the specifications, we lend them the money, we know we could sell that loan to this investor. They already got an investor lined up to buy it. That's why, excuse me, that's why when you get a loan to buy a house, within the first couple months, it's sold. You get notified your loan has been sold. It's like, I just applied for a loan. What do you mean? They already sold my loan? Yeah, because they want to get the money back, plus some of that interest paid up front, plus a servicing fee. Now they could, since they got that money back, they could lend it to someone else and originate a new loan and do the same thing over and over again. That's how lending works. But conventional lenders, most of the loans that they write, well, some loans could be originated and sold, but some of them they could keep in their own investment portfolio, because as you could see, you could make a lot of money on lending money to people and just off of the interest that you earn. So because the lender doesn't plan on reselling the loans, they have more flexibility in who they lend to as well. Now, that doesn't mean you should take all the people who got turned down and denied loans elsewhere to conventional to portfolio lenders because they have more flexibility because they're lending their own money. That doesn't mean that they're stupid. Are you going to lend your money to somebody because you have more flexibility to lend money to people? Are you going to lend money to people who have a bad history of paying back their loans? No. So don't take people with poor credit scores or poor history of paying back their loans to conventional portfolio lenders. They're not going to lend them their money. They'll lend them to people who don't fall into certain guidelines. Like a lot of these investors, they have guidelines that if you own more than 4 houses or 4 properties, you don't qualify for this loan. If your debt to income ratio is out of a certain ratio, you don't qualify for this loan. If you, they have like a lot of arbitrary guidelines that don't make sense even, you know. But I'll give you an example with that. I had a friend who I was helping him find a house, buy an investment property, and we found him one. It was a 2-family house in Linden that was about $200,000 for a 2-family house that was in really good shape too. And he was having trouble getting a loan to buy a $200,000 home where the rents would cover paying the mortgage itself. So why was he having trouble getting the loan? Because he already owns 15 properties. And most of the lending guidelines said if you own more than 4, you don't qualify. And then his debt to income ratio was thrown off because he's also a business owner. You know, he owns a bar, and bar's cash business, but he owns a bar and he has a lot of business write-offs when you own a business. He owns all these properties, so he writes off like I did these repairs and those repairs. So when he buys stuff for those, they're tax write-offs, right? But this guy's really cheap. My friend is really cheap. Ask me, Vic, how cheap is he?
Vic, how cheap is he?
How cheap is he?
He is so cheap that when he goes to Home Depot and he finds a receipt on the ground, he picks it up so he could write it off on his taxes.
I don't know if that's cheap. I think that's criminal.
I know, it's not a bad idea.
But the thing is, if you do that too much and you have too many write-offs, you see the result. He had trouble getting a loan because now if you just look at your taxes, the banks look at your paperwork and they look at his taxes, they're like, you're spending every penny that you make. How are you going to be able to afford to make a mortgage payment on this house? Right? So you're going to have trouble getting a loan if you have too many write-offs. Same thing like if you try getting a car. If you have too many write-offs on your taxes, it looks like you're spending all the money you make. How are you going to afford to make the payments on the car, right? It's the same scenario. So I took him to a portfolio lender, and they're like, okay, let's see. This guy, he's a bar owner. Yeah, it's cash business. He's probably not even reporting all the money that he's making. He's got 15 properties, never late on a mortgage payment. His credit score was, I think it was like 849. It was like phenomenal. And I couldn't get him a loan for $200,000 to buy a property that the rents would pay for itself. So they were like, we see what's going on here. And he's also a fireman, so he's got a salary from that. And they're like, this guy, we see what he's doing. A lot of investors do this. They try to pay as little in taxes as possible so they have more write-offs. But he's getting caught up and it's backfiring on him because he's trying to get a loan and he's got too many write-offs that it looks like he's not making any money that he could spend. He's spending every penny that he makes. So, we see this guy as a safe bet to lend our money to, and then they lent him the money because they had that flexibility. But if you go to one of these lenders that have these strict guidelines, and if you don't meet them, you don't get the loan, okay, that's the people that you take to portfolio lenders, not people with poor credit scores, okay? Now, government-backed loans, we have the FHA, that's the Federal Housing Administration. They insure loans. They actually don't lend money. Contrary to popular belief, people think you go to FHA, you get an FHA loan because the FHA lends you money. No, the FHA insures loan. That's the Federal Housing Administration. It's a governmental agency. They basically tell banks, these are our guidelines, and if the borrower meets these guidelines, lend them your money, and we will insure your loan against loss. So if they default on the loan, we will foreclose on them to take that property away, but we'll reimburse you, the bank, the lender, 100% to make sure you don't lose a penny. That's what the FHA program is. FHA does not lend money. Local banks lend the money. FHA insures that loan. The VA does something similar, except instead of insuring the loan, they guarantee 25% of it. So it's as if the borrower put down 25%. The VA is not giving 25% of anything to the lender unless the borrower, who's a veteran, defaults on the loan. If they default on the loan, then they pay them 25% of the loan amount. So because of this guarantee that's coming from the Veterans Affairs, Department of Veterans Affairs, that's guaranteed money, you know. So the borrower doesn't have to put any money down. It's as if the veteran put down 25%. So you don't got to carry PMI insurance or any of that. So a veteran can technically get 100% financing. Neither the FHA or the VA lends money. Both the FHA and VA loans, however, do require that purchase contracts contain a special amendatory clause that states if the property appraises below the purchase price, that the buyer can get out of the contract without penalty. So, for exams, what's a type of loan where the lender, what's a type of loan directly between the lender and borrower with no third-party involvement or influence? There's no third-party guidelines that are followed.
Conventional loan?
It's a conventional, or you could call it a portfolio loan. Yes. A type of loan that is insured.
FHA.
Agreed.
And the
VA?
The VA loan, do they insure or guarantee loans?
Guarantee.
Guarantee.
They guarantee 25% of the loan.
Yeah, VA guarantees, FHA insures.
Yeah.
So what type of loan can veterans get 100% financing on?
VA loan.
A VA loan. And what is the purpose of the special amendatory clause that all VA and FHA loans have to have in the sales contract? What is its purpose of the special amendatory clause?
That if the property appraises for less than, they have a out.
If the property appraises for less than the purchase price, the buyer can get out of the contract without penalty.
Without penalty.
You see a bunch of possible questions right there you get from this?
Yep.
Hint, hint. And then we have the NJHMFA. That's a New Jersey Housing Mortgage and Finance Agency. They don't lend money either, just like the FHA. The loans come directly from approved lenders to fund the various loan programs that they insure or guarantee. And then we have the Rec D. The Rec D is the Rural Economic Community Development, formerly called the Farmers Home Loan Association. And these loans are funded directly by the USDA, the United States Department of Agriculture. Okay. So if you guys want to snap a picture of this, do so, because then I'm going to show you just what to highlight on this page here. But this gives you a little more explanation than what they got here in the book on this under insured and guaranteed loans and conventional loans here. All right, you good?
Yes, sir.
So once again, urban, suburban, and rural. What is an urban area? It's a densely populated area. Has a lot of high rises and apartment buildings. People live within a close proximity. Suburban, also known as suburbia or suburban. These are a little less densely populated. They contain 1 to 4 family homes with more space between them. And rural, these are sparsely populated areas like farmlands and neighborhoods where your neighbors are far away, where you maybe can't even see them or you could barely see them, out in the countryside. Oh, somebody's phone's off the hook. Oh, that was mine. Never mind. All right, so I guess these are your notes there to highlight.
Can't see it.
What do you mean can't see it? What are you seeing?
I'm seeing you.
I can see it.
Oh, here we go again.
He's switching. He's switching his screen. He's watching stuff online, and then when he switches back, he can't see it no more. That's what it is. Okay, so
hold on yourself.
That out. Back there.
Government-backed loans.
Now you can see it, right?
I see it now.
All right.
Administration.
Boom, ba-doo-ba-doo, ba-doo-ba-doom, boom. Let me know when you guys got all the notes.
Okay, got it.
Give me 2 seconds.
Mm-hmm. You also got all the notes I wrote here, right? Like maximum seller concession allowed for FHA and VA loans is 6% of the loan amount. I gave you the abbreviation for New Jersey Housing Mortgage Finance Agency. Over here, conventional loans are originated by portfolio lenders with no third-party involvement or influence. And down here, maximum seller concession allowed for conventional loans is 3% of the loan amount. All right, you got all those? So what is a concession? What is a seller's concession? That's money that the seller gives up to the buyer to help them pay their closing costs or for repairs. The maximum amount they're allowed to be given, to give up.
All right, I got it.
Okay. Everybody's good? Kev, you good?
Yeah.
All right. All right. So how does lending work in a nutshell? Well, most lenders, they don't lend their own money. And those that do are called portfolio lenders, or sometimes people call them conventional lenders. And their loans are sometimes referred to as conventional or portfolio loans. So who do consumers get loans from? Well, you get them from banks, credit unions, and investors. Anybody know what a credit union is?
Isn't it like a company-owned banking institution?
It's a non-profit bank.
Mm.
So you got banks, credit unions, and investors. This is where consumers get money from to buy homes. Well, who are these investors, these private investors that you could go get money from when banks won't lend to them. These riskier loans that maybe charge a little bit higher interest rates, they call them commercial loans sometimes. Well, insurance companies, they sit on a boatload of money. They don't just sit on that money, they let their money make more money. So they lend as private investors. Investment funds, retirement plans, things of that nature. These are common sources of obtaining sources of funds for money, for loans. Banks lend their depositors money according to some third-party investors' criteria. We call those the lending guidelines for the loans they're willing to purchase. Then they sell those loans later to get their depositors' money back, plus some of the interest paid upfront as a profit. Sometimes these investors will also pay the bank a servicing fee to continue collecting of the monthly mortgage payments and billing and rendering accounting to the consumer and the lender. Now, that little explanation I gave you, explaining to you how lending works in a nutshell, it's actually false. It's actually not true. But you guys understand it better. And most people think that. So just go with that. Continue thinking that way. It's an easier way for you to understand how the lending works, even though technically it's not correct. I'll tell you how it really does work, and it'll blow your minds. Where do banks get the money from that they lend you to buy homes? Most people believe this story that I just told you. They lend their depositors money. That's how they're able to earn interest on their savings accounts, right? Really? You guys seen how much money that banks make off of lending? And how much are you making on your savings accounts? You think that they're really sharing that interest with you? You'd be lucky if you get a tenth of a point that they're of interest that you're earning in your savings accounts these days. You're hardly making anything unless you're going to one of these high yield savings accounts. And then it's possible to get up to 4 to 5% interest on your money. You know, I opened up a bank. I opened up a bank account, but a lot of these are virtual accounts too. Like you could open up an account with Discover. Even PayPal is now offering their own virtual banks, right? PayPal, Discover, or you could have actually a local bank, not Sovereign. Who the hell is it? Capital One. Their bank. I know they got one branch there in Edison. And I started one. I joined one in Florida online because they at the time had the best interest rate. They were offering 5% interest to earn on your money. So I signed up with them. But otherwise, you're making next to nothing on your savings accounts, right? Maybe a tenth of a point interest. You guys can sign up though for other banks, those online ones, and then you could do your deposits and withdrawals through like the ATMs at credit unions that they're also use. All right, so the primary mortgage market, sometimes just referred to as the primary market, is where loans are originated to consumers to buy real estate. So basically, any loan that you get to buy real estate, that's considered the primary market, the primary mortgage market. And then remember, I told you that those loans are then later resold to investors. That's called the secondary market, where the banks sell the loans to other banks or other investors. That's called the secondary market. No rocket science there to understand that, right? Everybody understands that? You get loans. The public gets loans to buy real estate in what is called the primary market, and then those loans are resold by their banks to other banks and other investors in what's called the secondary market. Okay, so you guys understood this how I told you how lending works in a nutshell, where the banks lend their depositors money. That part is technically not true, but all the rest of it is about how the servicing fees they charge and all that. Do you know where banks actually get the money to lend?
It's your money. They take your money.
They take our people's money.
No, they don't actually. That's what I have written here in the story because it's easier for everybody to understand when I first explain it. But that's actually not true. So where do banks get money that they lend? It's gonna blow your mind.
They steal it.
They conjure it up like a magician conjures a bunny rabbit out of a hat, out of thin air. It doesn't make sense, does it? I'm going to show you a video right now that's going to explain it. I already showed you, remember I showed you that teaser video about usury? What is usury? See if you guys recall. Usury. Almost all religions forbade it.
Making money on
interest.
Yep.
So making money simply by having money, right?
Oh, right. So, making money by having money.
And that's by charging interest.
Like interest. Mm-hmm.
You know, so you're right. You know, so that video I showed you, Money is Debt, came from this movie, this documentary, which is a cartoon. All right, so I've got it right here. It's called Money is Debt, Promises Unleashed. Money as Debt. I'm going to share this link with you so that you guys can watch the full video on your own time. But I am going to show you about 15 minutes of this video. And it's going to blow your mind about how banks get the money to lend, how lending works in the world and all that jazz. All right. So here we go. This is a great video on how money has value and how banking and lending works worldwide, but focusing on the USA. It's created by an economist, a world economist. He's actually based in Canada. He made this video. And instructor, please show. Okay, so I'm going to show you 17 minutes of this video. Okay, so let's watch. Enjoy. Let's read the credits as they scroll in and see if you recognize any of these. See if you recognize any of these names on here too. Not that name. But you'll see a couple more comments here coming up. You guys recognize that name? Mayer Anselm Rothschild, the Rothschild family.
Rothschild sounds familiar.
Oh yeah, that's one of the Men Who Made America. You guys ever watch that series, The Men Who Made America? It's a great series. On some channels it's rebranded as the Titans of Industry, and then others it's called The Men Who Made America. Permit me to issue and control the money of a nation, and I care not who makes its laws. Yeah, because you control the money. Money as debt.
Two great mysteries dominate our lives, love and money. What is love is a question that has been endlessly explored in stories, songs, books, movies, and television. But the same cannot be said about the question, what is money? It's not surprising that monetary theory hasn't inspired any blockbuster movies, but it was not even mentioned at the schools most of us attended. For most of us, the question, where does money come from, brings to mind a picture of the mint printing bills and stamping coins. Money, most of us believe, is created by the government. It's true, but only to a point. Those metal and paper symbols of value we usually think of as money are indeed produced by an agency of the federal government called the Mint. But the vast majority of money is not created by the Mint. It is created in huge amounts every day by private corporations known as banks. Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off. And the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, how would anyone find out? This new scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers. It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion, so instead the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down.
The central bank, that's what the Federal Reserve is. The Federal Reserve is the United States central bank.
Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk to nothing. The basic nature of money has changed. In the past, a paper dollar was actually a receipt that could be redeemed for a fixed weight of gold or silver. In the present, a paper or digital dollar can only be redeemed for another paper or digital dollar. In the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse, just as we have the choice to refuse someone's private check today. In the present, privately created bank credit is legally convertible to government-issued fiat currency, the dollars, loonies, and pounds we habitually think of as money. Fiat currency is money created by government fiat or decree, and legal tender laws declare that citizens must accept this fiat money as payment for debt, or else the courts will not enforce the obligation. So now the question is, if governments and banks can both just create money, then how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantities of whatever commodity was in use as money. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug out of the ground. In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit: the total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consists of three things: the amount of government-issued cash that the bank has in its vault, the amount of credit it has with the central bank, and the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. Investors have paid for the bank's infrastructure and have supplied it with sufficient cash to meet the demand for cash withdrawals. Typically, cash in the vault will amount to no more than $1 for every $20 or $30 that could be demanded from the bank. The bank has joined the central bank system, which permits the new bank to borrow cash from the central bank if it's needed. The doors open, and the new bank welcomes its first loan customer. The customer needs $10,000 to buy a car. On approval, the bank creates an account for the borrower and types in that the bank owes the borrower $10,000. This $10,000 is not taken from anywhere. It's created on the spot. The borrower does not take this money out in cash. Instead, he writes a check on his account to buy the car. The seller then deposits this newly created $10,000 check at her bank. At a ratio of 9-to-1, this new $10,000 deposit allows the seller's bank to create a new loan of $9,000. And if that $9,000 is then deposited by a third party, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls, each layer of which contains a smaller doll inside, each new deposit contains the potential for a slightly smaller loan in a decreasing series. Now, at any stage, if the money created is taken out in cash and not deposited at a bank, the process stops. That's the unpredictable part of the money creation mechanism. But more likely, at every step, the new bank credit money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new bank credit money has been created within the banking system. All of this new money has been created entirely from debt, and all transactions have been carried out with bank credit. None of the banks involved have needed to use any of the cash in their vaults. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be said that any one bank got to multiply the initial $10,000 of bank credit into $100,000 of bank credit. However, the banking system is a closed loop. Bank credit created at one bank becomes a deposit in another, and so on and so on. In a theoretical world of perfectly equal exchanges, the banks would owe each other nothing at the end of the day, and the $10,000 created out of thin air as a loan by the first bank could indeed become almost $100,000 of new loan money in the banking system. If that sounds ridiculous, try this. Actual reserve ratios can be much higher than 9-to-1. For some types of accounts, 20-to-1 and 33-to-1 ratios are common. There are also many exceptions where no reserve requirements apply at all.
All right. So that's where we leave off right there watching that video. What did you think? Interesting? Did you learn something about banking and how lending works and how they come up with the money?
Yep, they still steal our money.
Well,
not only kidding.
They're not actually using your money, though. But they do have to show that they have 10% more in their accounts than they're lending out. That's why they seek the depositor's money. They're not actually lending your money. They're just conjuring up money out of thin air.
Using it for collateral.
No, not even. It's not even used as collateral. It's just used to show the banks, the regulators, that they're having money, that they have deposits, that they have clients, that they're not just inventing money for their own use. They're lending it out. It's an interesting concept. That was 17 minutes of this 46-minute documentary. So I sent you guys the link to it. If you're interested, you could watch the rest of it. It was pretty interesting, enlightening. Have you ever heard of any of this? A lot of this is new to people. Most people don't even know this stuff. That's why I told you, banks lend their depositors money, but that's not really how it happens. Okay, so conventional loans. Now we know a little bit about banking and how it really works behind the scenes there. This is a pretty good notes for everything you need to know about conventional loans. These are loans directly between the borrower and the lender with no third-party involvement or influence. So they have more flexibility in lending. You get them from portfolio lenders and lenders who lend their own money with no intent to resell those loans in the secondary market because they keep them in their own investment portfolio to earn that interest. Don't confuse conventional loans with conforming loans. Those are two opposite, totally different things. Conventional loans, you get them from conventional or portfolio lenders, where they don't care about any third parties lending guidelines because they're not planning on reselling those loans. Conforming loans, however, they conform to some third parties lending guidelines. So they must meet that third-party lending guidelines. And Fannie Mae is the largest purchaser of loans in the secondary market. It's said that they buy 1 out of every 10 loans in existence. That's a lot for one company. So the lender has the final say in who they lend to because they're lending their own money. So they're more flexible. But that doesn't mean they make risky loans, the conventional loans. Typically, they require, the maximum seller concession allowed for conventional loans is 3% of the loan amount. And they typically require larger down payments, 20% or more. I've seen 25% or more, but as low as 3%. Now, if the LTV, what does that stand for? Loan to value ratio. If the LTV is higher than 80%, meaning that the borrower is going to meaning that the lender is going to loan you more than 80% of the loan amount, the borrower puts down less than 20% of their own money, then the borrower is required to carry what we call PMI, private mortgage insurance. So the next slide, we're going to explain what private mortgage insurance is. Well, maybe not the next slide, maybe the slide after that. So here's a few examples of local portfolio lenders I put together for you and how to find them. Basically, if you ever seen any unique construction projects and they have, those banners on them, this project is funded by.
Mm-hmm.
Well, that's not like, there's no standard lending guidelines for that project. They're lending their own money. So those are portfolio lenders that have those banners there. So just write their names down, you have them. Amboy Savings, PPAC Gladstone, Provident Bank, Unity Bank, Columbia, even Santander. Although Santander, even though they lend their own money, they usually only do it for larger projects, usually not on the smaller ones, for people just looking to buy a house. So PMI, this is everything you need to know about PMI insurance. It insures any amount less than 20% the borrower put down when purchasing. So if you put down a smaller down payment than 20%, you have to carry private mortgage insurance. So what does PMI insure? If the borrower puts down 5%, the PMI insurance insures the other 15%, the amount less than 20% that the borrower put down. Everybody got that? Yes? No? Jonathan, I can't hear you. You got your mic muted.
Oh, sorry, I was reading it.
Oh, okay. I saw your lips moving. I don't know if you were
screenshot
saying. Okay. I wasn't sure if you were saying something to me or not. I saw your lips moving, but I didn't hear nothing. Okay. All right. So when equity reaches 20%, PMI insurance coverage can be dropped by the borrower at their request. However, lenders must drop PMI insurance coverage when equity reaches 22% or more. When equity reaches 20%, what does PMI insurance insure?
The interest.
Nothing.
Oh, after, you're saying after it hits the 20%.
Yeah. When you put down, what is PMI? It's insurance for the lender, because traditional banking theory says that if the lender loans you more than 80% of the value of the property, they're risking their depositors' money. But so they require you, the borrower, to put down at least 20%. And if you don't, you got to carry private mortgage insurance to insure that amount. Now, if you put down 5%, the PMI insurance insures the other 15%. But what happens when your equity reaches 20%? Well, now you have 20% down. So the PMI insurance insures nothing. It only insures 20% of the loan. So when you got 20% of equity, you don't need it anymore. That's why it could be dropped when the borrower requests it once equity reaches 20%. How come the lender is allowed to keep charging you if you don't request it up to 22%? Well, because property values, they fluctuate. So they give the bank, the lender, that leeway. They're allowed to continue charging you insurance until equity reaches 22%, even though it doesn't insure nothing. It's not life insurance, and it doesn't insure the entire loan like MIP insurance does for FHA type loans. And once again, I just give you the explanation here of what equity is. Equity is the difference between the current market value and what you owe on the property. Usually at the time that you purchase a property, your down payment amount is equal to your equity. And the more you pay down your loan, the greater the equity you have. Or you could build equity by doing improvements on your home. Or market values can increase just on their own as they fluctuate with inflation, and you build equity. Let's do the highlights for private mortgage insurance, PMI, explaining what I just had in the previous slide. And how does the lender know when you've reached so much in equity? Do they get an appraisal again? No, often they just reach out to a real estate agent, ask them to do a BPO for them. Remember, we do BPOs, broker price opinions, for lenders in exchange for a fee. And we do CMAs for the consumers, usually for free. Either way, if you're doing a BPO or a CMA, on the bottom of every page, we have to write, this is not an appraisal and should not be considered as one. That is not be considered an appraisal, which is done by a licensed or certified New Jersey appraiser. And they give you a little note here. If you're going to be doing BPOs on the side to get money, remember, commissions, fees, anything that you earn because of your license must be paid to you through your broker. Let me know when you get it.
Got it.
Got it.
Okay.
Got it.
FHA has a bit more to learn about, but hey, the FHA stuff, we're going to highlight over several pages, but I got everything you need to know about FHA loans on one slide here. So not a bad study guide. So the FHA, the Federal Housing Administration, they actually don't even have their own website. Let me click on it. It was down the last time I looked. Biden put one up, but there was really no. It was kind of useless, like his presidency. There was really no information there. FHA loans, FHA website was always through HUD. You'd go to the HUD website to get FHA information, but he put up FHA.gov, but there was really useless information there. Let's see if it's up again. Well, okay, it's back up again. It's working. But look, it points to HUD.gov/FHA. It just forwards there. Oh, you can't see that, can you? So I clicked on FHA.gov and look where it took me. HUD.gov/FHA. And it's got some basic information here to other, not a whole lot of info. It's got some basics here, though. All right. The HUD website is usually where we get most of our information from. So either way, FHA insures loans but doesn't lend money. It insures the lender for the entire loan amount against loss, because the FHA says, hey, local lender, lend your money. And if the borrower defaults on the loan, we will foreclose on them, get that property from them, and we will reimburse you 100% to make sure you don't lose a penny. Darn it. Loans are for purchasing or refinancing owner-occupied one to four family homes, not for investors. These are only for owner occupants. See, these are FHA insured loans. FHA insures these loans because they require low down payment, much lower down payment than conventional loans, which investors may get. These loans are for owner occupants to help them. These are programs the government has to help people get into housing.
But you can do 5% conventional loan, can't you?
If you find a conventional lender that will accept a loan that low down payment.
Or
typically,
even 3% if I'm not.
Well, typically conventional loans are 20 to 25% down.
Yeah.
That's for investment properties. But if it's a property that you're buying for yourself to live in, I have seen conventional loans with as low as 3%. But those are like special programs that a local bank may be having or a certain investor will have. a lender will have. Oh, you know what? Let me bring something up. You guys are seeing it in the news all the time right now, right? They say Trump has weaponized the DOJ and he's going after his political opponents. Remember that New York prosecutors, Tish James, right? Remember she was going after Trump, saying that he lied on his mortgage applications or his insurance or loan applications, saying that Mar-a-Lago is worth more than it really is. And she claimed that, his Mar-a-Lago property was worth way less than what he claimed, when actually he probably underclaimed its value. And all the lenders said, who cares? He paid the money back. We know how much it's worth. It's up to us. We don't rely solely on what he said. But in the meantime, now she's being investigated. You see the charges on the news about this? Do you see what it's about? She applied for FHA loans for investment properties that she does not live in. She claimed she was going to live in them, but instead she is not living in them. The thing that you're seeing on the news, this is a current event right now. This is why I'm bringing this up. These are current events. You have a prosecutor. She knows the law. She bought a house in a different state. Remember, she's the New York Attorney General. She bought a house in a different state and claimed that that was her primary residence, even though on her taxes, she claimed it was an investment property. So she admitted in her own tax filings that she lied on her mortgage loan application. Plus, we know that she doesn't live in another state. She lives in New York. That's where she's the prosecutor, right? So she lied. This is what's going on. She lied on her mortgage loan application because these FHA loans are meant for owner-occupied 1 to 4 family homes. They're not for investors. So right there, this is showing you a current event that you could follow because you see it on the news all the time. Or I don't know. I guess it depends which news you're seeing. Some of them may not be talking about it at all, I guess. I don't know. But that's why she's being prosecuted. It's not Trump going after her. It's because she violated federal law. These are programs meant for homeowners, home buyers to live in. Why did the government make the FHA loan program that requires low down payments? What was the purpose of that?
To make it more affordable.
To make them more affordable for people who could not otherwise afford to get into housing. Okay. Meantime, she owns a bunch of investment properties and such. So this is meant specifically for, low-income people or people who don't have a lot of money saved up to make those larger down payments to purchase a home. So the FHA 203B is FHA's most popular loan program. It requires a low down payment insured loan. And the FHA has other loan programs available. They have adjustable rate mortgages. They have rehabilitation loans. Down here at the bottom of the slide, you can see they have the FHA 203K loan. This is one loan that covers both a loan to purchase the property and for doing extensive rehabilitation work to it. So if you want to buy a fixer-upper, you don't use that typical FHA loan, the 203B, you'd use a 203K. K for construction. I know you don't spell it that way, but it sounds that way, right? K, construction. Right? So there's a way to remember that. So you could get an FHA loan with a down payment as low as 3.5%. So they'll lend you 96.5% of the property's value. FHA does have minimum repair requirements. It does need to be in livable condition, not requiring a lot of repairs. This 203B loan, if you have the railing is loose or the steps are cracked or it has paint that's peeling, aka lead paint, you're not going to get a loan, an FHA loan, unless the homeowner repairs those things first, or you switch to get an FHA 203K loan. Why does the FHA care if the paint is peeling or the steps are loose or cracked?
Safety.
Here, let me give it another way. Why does the FHA care if the house needs work? Any kind of work. It's not about safety.
Is it because they've insured it? They've insured the mortgage though, so.
Well, why are you getting an FHA loan? Why not get a conventional loan? Why are you getting FHA loan?
Because the down payment is low.
Because it requires a low down payment. So, in other words, you probably don't have a lot of money. So therefore, the FHA figures they're looking out for the home buyer who's using an FHA loan by requiring the house be in move-in livable condition. Because if it needs a lot of work, they don't want you to buy a home using their low down payment program only to have to need to dump a lot of money into it to make it livable. So they figure they're looking out for you, the consumer, by having these requirements in place. Okay, even though you get a lot of people that don't have a lot of money, but they're generally like blue collar workers. They work in construction. They know how to fix this stuff and do it themselves. And then they get all ticked off because they can't use an FHA 203B loan to buy these houses. Well, in that case, get the 203K, K for construction. So they also require an upfront mortgage insurance premium called MIP to be charged at closing. However, it can be wrapped into the loan itself, which insures the lender for the entire loan in case of default. Only the government can come up with such instructions or such ideas. What is MIP? It's mortgage insurance premium. It insures the lender. It insures the entire loan. That insures the lender in the event of default. The borrower defaults. So the borrower has to pay for this insurance that insures the loan. And then they tell you it needs to be paid up front. But if you don't got the money up front, that's okay. You could finance in your monthly mortgage payment that upfront fee and wrap it into the loan. How's it an upfront fee if you don't have the money and you're financing it? So if you default on the loan by not paying the loan, the insurance ain't getting paid either. It's the government. I don't know. I can't explain it. Now, the monthly MIP payment is also required in addition to that one-time upfront mortgage insurance premium. You're also required to pay a monthly insurance premium. And that insurance premium can only be dropped when equity reaches 78%. So when you've paid off the majority of the loan, 78% equity, but only after you've had the loan for at least 11 years. And only if you put down at least 10% at the time you got the loan. Otherwise, the insurance coverage can never be dropped. Why do most people get FHA loans again? Refresh my memory.
Less money down.
Lower down payment.
Only 3.5% down. So how much do most people put down?
3.5%.
3.5%.
Yeah.
So most people will never be able to drop the MIP insurance. Now that's a whammy that President Obama put in there just before he left office. It used to be you could drop the MIP coverage when equity reaches 78%. I think it was after 7 years. And they did not have this requirement here that you could only drop it if you put down at least 10% when you got the loan. He added that in. Why did he do this? Can anybody explain to me why he did this? Think about what was going on during his presidency. They were still in a recovery from a market crash that was still crashing even. Remember the FHA insurance program went bankrupt? They needed bailout money. Remember, all these banks were failing. Half the loans out there were FHA loans that were defaulting, and the FHA insures the lender against default. President Bush, he did a bailout. All that money was gone. It still wasn't enough. So then President Obama had to do a second, even larger bailout. A lot of it was refunding the insurance program to pay the insurance for those lenders for all those loans that were defaulting. So he said, we keep running bankrupt. We don't want people to do this in the future. So a lot of people, they're not paying their insurance premium. So what we want to do is make sure that they can never drop the insurance if they didn't put down at least 10% when they get the loan, knowing that most people don't put down 10%. In other words, he's making the FHA loan program a good program to get into home ownership, but not one you'd want to be in for the long haul. So when you reach 20% equity, refinance into a conventional fixed rate loan and get the hell off the FHA program that insures the entire loan for the lender. That's why he changed these rules, to make it less desirable to stay in the FHA loan program for the long term. Mm-hmm. Now, the maximum seller concession allowed is up to 6% of the loan amount, not the purchase price. The borrower may be able to finance some of their closing costs. Wow. Let me give you a little picture of what's going on here so far. When you get an FHA loan, it requires low down payment, 3.5%. But because of that, you now need to carry a mortgage insurance premium, MIP, that insures the entire loan. Not just the down payment, less than 20%, but the entire loan. But if you don't have that upfront insurance premium, you could wrap it into the financing of the loan. And you also have to pay a monthly insurance premium on top of that.
They have to pay two insurance?
Well, the one-time upfront insurance premium and then the monthly insurance. You got to continue paying it monthly as well. It's the same insurance. You just got to continue paying it monthly. And you can finance some or all of your closing costs. Wait, so how much money did you have in there altogether? 3.5%. How much is that insurance premium? Let's take a look and see if the book tells us. For the FHA loan, you pay as much as 1.55% per year on the mortgage insurance premium. The one-time upfront insurance premium that you got to pay is 1.75% of the loan amount. We're already over 3%. You only put down 3.5%. And on top of that, you could finance any or all of your down payment and closing costs. Oh, wait, above that. The borrower may be able to finance some of the closing costs as well. Closing costs are typically 2 to 3% of the purchase price. So that means you could borrow more than 100%. More than what the collateral is on that house.
All right, so can we dummy it down for the dumb guys over here? So if a loan is, let's just say 300,000, right? And you're supposed to put 3.5% down. But you're only approved up to 300,000, right? So you're at the max of your loan. You can add the closing cost in there and go over the 300,000 and they'll still.
Yep. Plus you have to pay the mortgage insurance premium, that one-time upfront mortgage insurance premium, which costs 1.75% of the loan.
Okay, hold on. I
And
need to write this down so it can make sense to me.
okay.
All right. So the loan, we're saying a loan is 300,000, right?
Okay, forget about the loan amount. Let's just look at the percentages. How much money do you have to put down? 3.5%. Write
Yeah.
down 3.5%. That's how
Got
much
it.
money you need to put down. Okay.
Uh-huh. Yep.
And okay, now subtract 1.75% from that.
From the 3.5?
Yeah, of the because it's the 1.75% is of the loan amount. So write down 1.75.
Okay.
So 3.5 minus 1.75.
Uh-huh.
What do you got so far?
Why are we subtracting it from 3.5 down?
Well, 3.5 was your down payment, right?
Uh-huh.
That's how much money you have into the house.
So you have 1.75.
1.75 is the insurance you're supposed to pay up front. So let's subtract that 1.75 from your 3.5.
It's 1.75.
Now you have 1.75 left. Okay, and now you also okay, forget about the other. You also have to pay another additional each year. You have to pay 1.55% of additional mortgage insurance premium. So subtract another 1.55%.
So you got 0.2.
Now you're at 0.2. And your closing costs are typically 2 to 3% of the loan amount. Purchase price or loan? They're usually about 2.2 to 3% actually of the purchase price, not the loan amount. But let's just go with the loan amount. So let's just say 2 to 3%, because that includes your prepaid taxes and insurance for the coming years. It's not really have anything to do with the loan. So your closing cost is estimated to be about 2 to 3% of your purchase price or the loan amount. It doesn't really matter. It's just ballpark figure, because that's your taxes and homeowners insurance. Okay. So now where are you at? You're in the negative now, right?
Yeah.
So that's over 100% financing.
I'm still lost a little bit.
I think you gotta break it down a little more.
Okay.
I kind of get it, but don't get it.
I guess for me, it's
I'm
just
like
what
between
I'm
the
trying to
three.
understand is if let's just say we were at a max 300K, right? That's the purchase price and the loan that you're approved for. So you're approved for 300,000. You say, okay, I'm gonna buy a house for 300,000, right? Even though technically you can't, right? Because they automatically bring the loan down based on the.
Hold on one second. I'm gonna see if I could.
Right, because if you're approved for 300,000, they may say you're only going to get they're only going to give you 280.
All right, you're wanting to look at numbers, so I'm gonna show you some numbers then.
Sorry, guys. I'm just confused, and I'm just like, man.
That's fine. That's fine.
All good.
I'm
It's
going down the
basically
same road.
yeah, it's basically all these extra expenses can be added into the loan because you don't have to pay them up front, you know. So okay, so just to show you really quick, how do I put typing up here? There we go. So let's just say you said $300,000 loan, right? Or
And you are pre-approved for 300,000.
okay, so $300,000 loan times you're supposed to put down 3.5%. Let me pull out my calculator. $300,000 loan times 3.5%. That's $10,500, right? So this is your 3.5%. That you have to that you have to put down. Okay. Now you have MIP insurance equals 1.75%. So 300,000 times 1.75%. Mm-mm. 0.75%. That's 5250. Okay. And that's your MIP. That's your upfront MIP coverage. And then we also have closing cost, right? So closing costs are mainly your taxes and insurance. There's some other expenses that are wrapped in there. It's estimated to be 2 to 3% of the closing cost. Okay. So let's just say your closing costs are
I put it 3%, so let's just say $9,000.
Here, let's put 9,900. Let's say the taxes are 9,000 and the insurance is 9,900. Okay, so let's just call it 9,900. Okay, that's reasonable, right?
Yep.
Okay, so this is your taxes and closing cost, taxes and insurance is 9,900. You also need to pay annually a 1.55% a year additional mortgage insurance premium. So MIP annual 1.55%. So 300,000 times 1.55%. That's 4,650. So let's see, what do we got here so far? Let's add it. Let's add up what we got here so far. We have 10,500. That's the money that you got into purchasing this house, right? That's your down payment. You're in $10,500. But you need to pay 9,900. So let's subtract 9,900 from that. And now you're at, let's see, 10,500 minus 9,900. Now you're at a balance of $600 that you're all in so far.
So you're saying that that's being deducted from your down payment?
Well, this is money. This is additional money that you have to put down. But instead of putting it down, you don't have it. You're financing it into the loan.
Into the loan. So you can end up not putting down any money. Is that what I guess that's what I'm trying to understand?
Yeah. Not only are you not putting down any money, you're borrowing more than the property's even worth.
Jesus.
Because look, already you're at $600, and then now let's also subtract an additional $5,200. So you're already in the negative, right? So minus 5,200 minus 5,200. That puts you
$9,300.
That puts you at negative 4,600 so far, right? And then another 4,650 over here. So now let's subtract another 4650. And where does that put you in the negative? That puts
93.
you minus 4650, 9250. You are negative 9250 already. So what percentage does that work out to be? Well, I tell you what, it's more than the property's worth. So you're financing more than the property's worth. So you could be borrowing 102 or 103% of the loan amount, or maybe even more. I think it goes up to 105%. I actually worked out the numbers one time before. It actually works out to more than it could work out to more than 105% that you borrow.
Even though that you pre-approve is for only 300.
Yeah, because you're adding in the closing cost you're financing into the loan, the mortgage insurance premium that you're supposed to pay up front, but you don't have to. You could add it into the financing of the loan. You could, the annual insurance, well, you'd be paying that, but you're financing it. And the, what did I miss? Closing costs, the MIP, and the annual MIP.
Okay, let me see if my mind is clear on this. So what you're saying is to buy a house, I only need like a pre-approval letter so far. As far as like,
well, you don't need a pre-approval. You need the actual approval loan.
Well, yeah. You need, okay. So you're going to you get a loan. You get approved for a loan for the FHA program, but they tell you it's not 100% financing. You have to put some of your own money down. You have to put 3.5% down, right? Right here is 3.5%. You put that money down. Now you have to pay additional expenses of closing costs, but you don't have that money. So you're going to add that into the loan and finance it. So your loan is actually going to be more than 300,000. It's going to be, at this point, it'll be $309,900.
I get it now. All you got to do is
plus this.
All you got to do is basically get the down payment and financial the closing costs.
So you're still, so I guess that's where the other question was. You're still putting down, you're still giving them 10,500, but your loan is for more.
But you're borrowing even more than that 10,500 that you should have been paying.
Yeah, I know. I guess that's where the confusion was for me. It was like, wait, so if I'm paying, I'm still putting down, because my loan is 300,000. I'm still putting down the 3.5, which is the 10,500. However, once you start adding in the closing costs, the MIP annual and the MIP up front,
that eats away
that loan now becomes 300 and
more. Yeah.
Yeah. So just so I do the math correctly. So 300,000 plus 9,900 plus 5,250 plus 4,650. So that loan ends up being a loan for 319,800, but you're still putting down upfront 10,500.
Correct.
Okay. That's where the confusion was. I'm like, wait a minute. This looks crazy to me.
Yeah, because all this other,
it's like when you buy, it's like technically it's like when you buy like I don't know, a car, a motorcycle, something like that. I mean, you end up financing something, and then your loan goes up to
let's use that. Let's use your example there. If you're buying a car or a motorcycle or something, you got whatever the purchase price is of that car or motorcycle. Now let's say they have document fees and other financing fees that they charge you, but you don't got the money to pay them. So instead, they just add it into the purchase price. So you're financing that over the term.
And that's what the people don't, you know, when they put those advertisements on TV
Yeah.
saying, oh, we can get you a car for 300 a month, let's say.
Mhm.
Well, they put you the little letters on the bottom and say that's if you pay the other fee and other paperwork that it needs to be done before that.
Yeah. Well, they a lot of that fine print that you're also seeing is for the Truth in Lending Act, TILA, you know, that requires them to disclose all the financing terms too. But then they're also disclosing doc fees and other things, other fees like that. I don't know if they're disclosing those on commercials, but they're definitely disclosing in those commercials in the fine print and the speed talker. They're talking about the APR, the down payment amount that's required, and what the term is, you know. So that they can comply with Regulation Z, which talks about truth in financing or full disclosures and truth in financing when borrowing. Let me see. What the hell happened to my, oh, here it is. I got to go full screen again. Hold on a sec. I'm sharing the wrong window with you. There we go. All right, so let's get back to the FHA loan program here. We got a little bit off track there with all the additional fees there, but that's okay. You basically have an understanding that it could end up that you're financing more than just the purchase price. When you could finance the insurance, when you could finance the closing costs, it ends up more than that 3% down payment that you put down. You end up financing it. It kind of eliminates that. So the any or all of the down payment and closing costs could also be a gift and not a loan from the buyer's relatives. How come a gift is okay but not a loan?
Because
Because
a gift gives no indication of your own ability to pay, and there's no expectation of repayment or being able to sustain it.
Well, having to repay it. Yeah, so
Yeah, having to repay it doesn't create additional debt.
Yeah, because if you're borrowing the money for that down payment and closing costs, well, then they have to factor that into your debt to income ratio, and that could screw up your ability to even get this loan now because they didn't factor that in, that you didn't have the money for the closing costs. And if you have to borrow that money for the closing costs, they have to factor that in to your qualifying for the loan itself.
Got it.
So, as a matter of fact, if your parents give you the money for the closing cost, the FHA is going to want them to sign a document certifying that this is a gift and not a loan and does not need to be paid back. So if it is a loan and you're just saying it's a gift because they won't allow it unless I say it's a gift, you know, wink, wink, nod, nod, I'll pay you back. Oh, they better be very trusting of you because they're going to have to sign a letter that says it doesn't need to be paid back. Now, FHA loans before December 15th, 1989 are assumable by anybody who doesn't even need to qualify for the loan. But buyers assuming loans after that date must qualify for the loan in order to assume it. But they don't need to pay closing costs or loan origination fees or anything like that because the loan's already in existence. FHA 203K loans cover one loan to purchase the property and for additional money for extensive rehabilitation of the property. Like if you want to buy a house and it needs the kitchen remodeled, or you need to put an addition on, or to build a garage, you could get one loan that will cover the purchase price and the construction that needs to be done. They actually, it's not construction, they call it a rehabilitation loan to fix it up, you know. Now, that money, that additional money, they don't just give it to you because you buy a house. You got to get a contractor that's willing to do the work and supply the materials up front. And as the work is done in phases, they get reimbursed by the lender. How do they know the work is done in up to stage one or phase one of the construction is done? well, they'll send out the appraiser again to inspect and make sure all the work required of phase one has been completed, and then they'll authorize the release of the funds to the contractor who supplied the materials and did the labor up front. And that a mandatory clause needs to be added to FHA loans that says if the property doesn't appraise for the purchase price, the buyer can get out of the contract without penalty. They don't have to go through with the purchase. But if they want to, they can. But they're going to have to dig that extra money out of their own pocket to pay the difference, more than what an appraiser just said that it's worth. All right. Now, New Jersey has, actually, all states have maximum loan limits you can borrow from the FHA. How much can you borrow from the FHA for a one-family, two-family, three-family, or four-family house? It depends what county you live in. So we have richer counties and we have poorer counties. So here, let me pull this chart up here. New Jersey loan limits set by county. I'm going to click on that. And it takes us to HUD's website here about FHA mortgage limits. Remember what I was just talking to you about? You could end up paying more than the property's worth. Actually, it comes up right here. You could pay up to 115%. Oh, wait, no, that's not, that has nothing to do with that. Never mind. That's something else. Okay, so let's look at New Jersey. What are the loan limits by county? Here, we're going to sort it by county, and we got New Jersey. Everybody see this? I'm sharing the browser window.
Yes, sir.
Yes.
Yes, sir.
Okay, so you could see we're on the enterprise.hud.gov website. This is talking about fiscal year 2025. Do they got 26? No. 2025 loan limits by county in New Jersey. Let's send it and let's see what it is. So here you can see right here is the median sales price. You see on the right side of the screen, that's the median sales price for and this is the county name. Atlantic County is one of the cheaper counties. For a one-family house, they'll lend you up to $524,000. For a two-family, up to $671,000. Three-family, $811,000, and four-family, over $1 million. With the average sale price being $342,000. Now, Bergen County being one of the more expensive counties, for a one-family house, you get an FHA loan up to $1.2 million. Two-family, $1.5 million. Three-family, $1.8 million. Four-family, $2.3 million. These numbers are freaking insane. I'm wondering if I could pull up how much it actually was. I'm wondering if I could look up what it actually was years ago when I started in the business. I don't think so. Damn it. So, look, what county are you guys going to be working in? Middlesex, Union counties? What counties are you guys in?
Essex.
Middlesex.
Essex County. Where's Essex? We'll start with that one right here. It's one of the more expensive counties, so 1.2, 1.5, 1.8, and 2.3, with the average $1.1 million sale price in the whole county. Of course, you got cities within Essex County that are cheaper than others, you know, but on average in the whole county, these are the average. These are the what they'll lend for 1, 2, 3, and 4 family, with the average being 1.1 million. And Middlesex County right here, that's also one of the more expensive counties. Same thing. And Union, one of the more expensive counties, has same thing. Look, Warren County is actually one of the cheaper counties. $524 for one, This is rural area. 671, 811, and $1 million. And the average sale price is $350 in Warren County. All those are pretty much up there. I guess Salem's in between. They're a little bit more. Instead of 524, 594 the land, because their average sale price is 517. All right, so that's how you could see how much, if you could even get an FHA loan to purchase the house you want to purchase. Because the home that you want to purchase, if it's over those loan limits for 1, 2, 3, or 4 family house, you can't get an FHA loan to buy the house. You understand that?
You can't get the loan, or you have to pay the balance.
Well, look, if you're going to buy a house in Atlantic County, a 1-family house, the FHA will lend you $524,225.
Yeah.
But the house that you're buying is $540,000. The FHA is not going to lend you $540,000.
Yeah, but they'll lend you 524, and you can come out the pocket for the rest. No.
Yeah, you got to put down for the 524 though. You're going to have to put down 3.5% still.
Yeah.
Plus any additional money that's needed in between.
Yeah.
A lot of people may not have that kind of extra cash laying around.
No, I understand that, but I was just saying. So now, if you bought a house for 524 and they gave you the 524, you can still end up getting a loan for 540, as we discussed before.
No, they're not gonna lend you the difference.
No. If the house was 524, if the house was 524, 225, right? You have the 3.5%, but now you have to pay the closing costs. You have to pay the MIP. They won't lend you more than.
Well, they'll lend. You could wrap in the cost of the MIP and all that stuff into the loan.
So that loan ends up being more than the 524.
Yes.
Only that's the only scenario where you get more than.
Yes. But they're not going to lend you, like, if the house is valued for more than this, they're not going to lend you that amount to purchase that house, because they'll only lend up to this maximum amount, other than the fees you're wrapping into the loan for the insurance and stuff. Yeah. So you can look this up. If you see that the home is worth more than this, you're going to need to get a jumbo loan. A jumbo loan is exactly what it sounds like. It's larger than the lending limits that are allowed by the FHA. And if you want to buy a condo using an FHA loan, well, the condo complex needs to be approved. Now, what's required for a condo complex to be approved by the FHA? They have certain building material minimum standards that they need to have used to build the condos. The majority of the units had to have already been sold. So more than 50% of them are already sold. And the majority of that needs to be owner occupied, because they're looking out for you, because who takes better care of the property? Owners or renters? Owners. So they want to make sure that the majority of the units are owner occupied. Otherwise, so you got to have minimum standards of construction. The majority of the units need to be sold and owner occupied. Otherwise, you won't get an FHA loan to buy a condo. And they have to have certain finances and things like that have to be up to standard too. So let's take a look at, New Jersey. Let's look at Edison, right? Edison has a lot of condos in it, right? Let's see how many of them are approved. Now, keep in mind, once a complex is approved for an FHA loan, that approval is good for 20 years, and then they need to resubmit an application. Obviously, nothing's going to change with how they constructed the building, but their finances and management and owner occupants, those reports need to be resubmitted to make sure they're up to snuff. Otherwise, and then the complex will be renewed for another 20 years. Now let's take a look at this one. Here's an older complex in Edison, the Aspen. It already contains 1.96% of the units have FHA loans. So it already expired. So somebody tried to reapply to get the complex approved for FHA loans in 2018, but it was rejected because missing documents or incomplete package was submitted. And it doesn't look like they tried to go through with it again. Here's another complex, Brookview, older, expired. It already has some FHA loans there. They tried submitting it. Let's see. Status dates, 1990. 2011, somebody tried to apply for it again. It was approved but expired in 2011. I'm not sure what these dates are here. Expiration date versus status date. It doesn't make much sense. Well, maybe it was just updated in their database then, but it expired in 2012. Okay, so it was approved at one point, obviously, but expired. Approved, expired, withdrawn, rejected in 2012, approved, expired, rejected. I'm not sure what that means. Register single unit, rejected, missing documents, incomplete package, expired. Results of project review were withdrawn. Okay. Rejected, approved, expired, rejected. None. There are no approved condos in Edison that are currently approved to use FHA loans. Why? Because I'm sure there's a lot of conventional loans out there that were allowing the same down payment requirement, and there was less hassle to try to get the whole complex approved again. What about Woodbridge? Woodbridge got a lot of condos, right? Let's check Woodbridge.
Hey, Vic, do you mind if we fast forward past this part? I've got house guests, so I have to kind of cut out close to the 4:30 mark. But I want to make sure I get the instructions for how we proceed.
Sure. Oh, I wasn't even showing to you guys. You guys didn't even see it on screen.
I noticed, but the content mattered more than what you're looking at.
Yeah. Okay. Yeah, you guys weren't even seeing it. So the FHA approved condos, HUD homes, when FHA loans get foreclosed on, they turn them over to HUD, and then HUD sells them. They become HUD homes. These are HUD auctions. You need to be a approved FHA or HUD approved real estate agent in order to sell HUD homes. FHA lender site. Here's an FHA lender site that has a lot of good information on it too. It's actually FHA.com. It has nothing to do with the FHA. It is just a lender. They got a good domain name, FHA.com. Okay. So these are just the highlights now for all that stuff that we went over and that we had the notes for on that one slide. If you didn't take a picture of that last slide, let me know and I'll go back. You can snap a picture of it. Otherwise, these are the notes to highlight on page 276.
Got it.
Hold on.
Okay.
Oh, I see it. Okay, got it.
All right, Kev, you good?
Just give me 1 second.
Sure.
The last word, please required them. I got it.
Continue on page 276 under 203B. You're basically highlighting the first sentence. And then in the next paragraph, the first sentence. And then in the following paragraph, the first sentence. And in the last sentence of that same paragraph, you're highlighting seller concession may not exceed 6% of the loan. And then move on to the next page under the second paragraph at the top of the page. Write, actually, you don't need to write all this. These are notes that I have in here because this is where President Obama changed the law. If equity reaches 78% and the buyer put down 10%, it could be dropped after 11 years. Over here, they just wrote, FHA requires that most borrowers who make less than 10% down payment continue to pay annual premiums for the life of the loan. Okay, I'm just giving you the information that under what circumstances can you drop it, that MIP premium. If equity reaches 78% and you put down at least 10% and had the loan for at least 11 years. Okay.
You got it.
All right. Page 277 under estimate of value. First sentence in the first paragraph, highlight. Second paragraph, highlight up to 3.5% in that next sentence. The FHA allows down payment at lowest 3.5%. And then where it says and will, cross out the word will and write lenders may consider applicants with credit scores as low as 580. The FHA actually does not have a credit score requirement at all. It's up to the local lender because they're the one that's lending the money. And then highlight the first sentence in the next paragraph. FHA borrowers are allowed to finance a portion of their closing costs. And then also highlight the last sentence in that same paragraph. And under repair requirements, just right next to that, minimum repairs allowed. Yeah, I packed a lot of stuff in that one FHA slide. A lot of information on there. Everybody good?
Yes, sir.
Yes, sir.
Okay, continue then. Occupancy requirements. Borrowers must intend to occupy the property, and these loans are for 1 to 4 unit properties. Under assumability, highlight may be assumed, but right above that, FHA loans may be assumed. The older ones, the borrower doesn't need to qualify. The newer ones, they do. They still need to be approved. So FHA mortgages are assumable if the new borrower who must intend to occupy the house qualifies for the lender's standard. So I guess we didn't have to do this one up there then. Same, that's repetitive. And about the 203K mortgages, allow one loan to cover both the purchase price and extensive rehabilitation work. Well, that's already on the next page, 278. And for either FHA or VA loans, they got to have that special amendatory clause that says if the house is not appraised for the purchase price, the buyer can get out of the contract without penalty.
Got it.
Got it. Thank you.
All right, here's an example of someone doing a FHA 203K type of loan. These people did not use a 203K loan, I know that. But this is an example of just like where people are using FHA 203K loans, they do the same exact thing. Take a look at this picture. The entire house has been torn down except for the garage and one wall, which this wall ended up coming down too. They just didn't tear it down yet because it had the power line going to it. Here's another image of it. See, they just left the garage and that wall. That wall eventually came down. Here, it's still up there. And then they built this. Look at it compared to the neighbor's house. Huge. This house is actually 3.5 times the size of this house. Plus, they built the basement deeper and wider for the full footprint. This is an old builder's trick because the tax man in most municipalities does not communicate with the building department. So as far as the tax man's aware, this house was still built in 1953, remodeled in 2024. Here, let me give you an aerial view. You could get a better view of the aspect of the size difference.
But the FHA doesn't allow you to tear down, though, right? Only to.
Well, they allow extensive rehabilitation. But what does that mean? Extensive rehabilitation. As long as you leave one original wall standing from that house, you could tear down that entire house, excavate the basement and dig it deeper and bigger. As long as you have one original wall. They left the garage. They built the whole new house around the original garage. Look. This is the garage. You see the garage on the lower right? Yeah. They built a whole new house around that. That garage they left. Look, it's still there. They built above it, they built around it. It's a whole brand new house built around that one garage. So technically, it's not new construction. Isn't that crazy?
Still had the garage in there.
All right. Here's everything you need to know about VA loans. It's intended for veteran-owned or co-owned occupied 1 to 4 family homes. We're almost done with this. For 1 to 4 family veteran-owned homes or co-owned veteran homes. The VA no longer has lending limits. It used to. That was changed. But the VA will guarantee 25% of the loan amount for properties valued over $144,000, which they'll lend. Therefore, no down payments required. These could be 100% financing for the veteran. However, the veteran must qualify with the lender, of course, still to be able to get the loan. They have to have the special amendatory clause in the contracts to purchase the property, just like with FHA loans, that says if the house doesn't appraise for the purchase price, the veteran can get out of the contract without penalty. Appraisals for a VA loan, they have a separate name. They got their own name. It's called a Certificate of Reasonable Value, or CRV for short. And a lot of people remember this when I say Honda CRV. Just remember, think of the Honda CRV. For some reason, people always now remember, what is a VA loan? What is a VA appraisal called? CRV. They think of Honda CRV. It's a CRV, Honda CRV. For some reason, I don't know why, for some reason people remember it that way. Discount points may be paid by the seller, the buyer, or shared between them. The veteran, however, does have to pay an application fee. They call it a funding fee. But that fee can be waived for, disabled veterans. And National Guardsmen and reservists pay higher funding fees. They used to be considered part-time military people. But, we've had a shortage of people in the military for a while now. I think there was a lot of social experiments going on in the military, so it was hard to recruit people. People were just dropping out of the military. They didn't want to be involved in it, Now we are currently fully stacked with the military personnel again. We've met our goals again. That's good. It was getting kind of dangerous when the military doesn't have enough people that they got to take the National Guardsmen and reservists and put them on the front lines to be fighting in wars overseas or whatever, right? But now we're fully stocked up again. I don't want to get into the politics of it, but you get the idea. VA loans can be assumed by anyone who does not need to be a veteran. You don't need to be. Do you need to be a veteran to get a VA loan? Yes. Do you need to be a veteran or a member of the military to assume a VA loan? No. That's often an exam question. Okay. So as long as you meet the eligibility requirements, you can get a VA loan, the initial loan. And that is, you have to serve 90 days consecutive of active duty during wartime, 181 days of active service during peacetime, or 6 years in the reserves or National Guard. And just in case you didn't know, our politicians came up with crafty ways to save their reputations so that they could, when they go for election, they say, no new wars were started on my watch. Yes, instead of calling them wars, they call them military exercises or some nonsense like that. They are actually not wars. Like even us being in Iraq, was that a war?
I mean, they didn't call it a direct war, so no.
So technically it's not a war, even though we were there for over 20 years, right? It was not a war. All right, so here are some resources I got down here on the bottom here for you pertaining to VA benefits. And I often talk about movies or documentaries, and here's a couple of good ones if you wanted to watch them. Band of Brothers, if you have never seen it, that's an excellent HBO miniseries. You could see it on Netflix and Amazon TV and all that. Stripes too. If you've never seen Stripes, anybody ever hear of Stripes? They don't make comedy like this because it's politically incorrect the way that they act in the movie, but it's funny as hell. If you like funny as hell movies and you don't care about political correctness, Stripes is a great movie for you to watch. It's got Bill Murray in there. It's a real funny movie. Write it down, look it up later. Check it out this weekend. Stripes. And Band of Brothers, that's a 10-part series, though. You're going to be sitting there for the whole weekend watching that. But it is excellent if you like war movies. It's actually a true documentary, but they turned it into a movie. And during the breaks between the movies, they actually interview some of the military people that actually served in these roles that they show in the movie. Great. All right, moving along. So we do these highlights now for the VA, page 278. You just write next to the title, can be assumed by non-veterans. The loan is made by local lending institutions. The VA guarantees 25% of the loan. No down payments necessary. The loans are guaranteed by the VA. So you could get 100% financing because no down payments required. So veterans can purchase single family or owner occupied 2 to 4 unit home. VA appraisal statements called a CRV. They got to have that special amendment clause in those loans. And there's no maximum loan limits, but there is a minimum now as of 2020. It's $144,000. Oh, just let me know when you got all those highlights and notes.
Got it.
Got it.
Good.
Okay. All right. So NJHMFA, that's a New Jersey Housing Mortgage and Finance Agency. They offer below market interest rate loans with little or no down payment to qualified buyers, not investors. They got to be owner occupants who live in urban target areas. They apply through various local approved lenders for the different loan programs that they offer. And they have programs for first-time home buyers. You'll be blown away about what a first-time home buyer is considered to be. What do you think a first-time home buyer is?
Someone who hasn't bought a home in 3 years.
3 years.
Where'd you guys get that from?
You told
Do I
us.
have that written here? Or I told you once before, right? Okay. Okay. At least you remembered, that's good. Okay, so they got many special loan types. First-time home buyers, live where you work. If you go to work in off-peak hours, for police, fire, teachers, firemen and teachers. They also have interest-free loans up to $10,000 for homeowners using well water to install a water filtration system. And loans for first-time buyers, they have a down payment assistance program. It's called a DPA program, down payment assistance, where they'll loan you the money for the down payment and or closing costs, and you don't have to pay it back if you live in the house for at least 5 years. Here are the resources for the NJHMFA, also in the ClassLinks Word document. So let's do these highlights for it. These are also for 1 to 4 families, not for investors, but for owner occupants. You can be an owner occupant and an investor, though, right?
Yeah, you can live in the same.
Yep.
Especially
Yeah,
you do a 4-family, you could live in one unit and then rent the other.
That's not a bad idea for your first home, right?
Not at all.
That's the idea of going. I'm going.
And these loans are for people who live in urban target areas. You should underline that because that's an exam question. Hint, hint.
Got it. Thank you.
All right. Okay. So here's some more information about it. First-time home buyers are defined as not owning a home in the last 3 years, like you guys just informed me. Borrowers' income must not exceed 140% of the average income, the median income, to qualify for the loan. It's a second loan up to $15,000 for down payment assistance program, in addition to another $7,000 if you're a first generation home buyer. I'm not sure what that qualifies as. For a grand total of $22,000 they could give you that you do not need to pay back. Now, you have to get your loan to purchase the house, that 30-year fixed rate interest loan. You have to get through the NJHMFA to get this down payment assistance program loan as well. And this is how the loan works. If you live in the house for 5 years, you do not need to pay back that $22,000. If you live in it for 4 years and you sell, you got to pay back 25% of it. If you sell the house in 3 years or less, you pay 50% back. 2 years or less, 75%. Or if you a year or less, you got to pay it all back, that money for the down payment and closing costs. So here's some of the different loan programs they have available and a link to their website, NJHMFA loan program. This is their website, njhousing.gov, and the roadhomenj.com. These are more consumer friendly pages. And here's some of their specific pages to their lenders lists that are approved lenders that you could get the loans from under their programs. Their home buyer guide, which I already shared with you. Here's the flyer for getting that $10,000 for their interest-free loan for water filtration systems. You're better off just getting it directly from the slide or the ClassLinks Word document, though. And the REC-D, that's the Rural Economic Community Development, formerly the Farmers Home Loan. You get this for loans in rural areas. For 1 to 4 family homes, not for investors, again, owner occupants. First-time home buyers, farmers, or just people who live in rural areas. You could get in these loans, you could get with interest rates as low as 1% interest. 1%. And the loans are funded directly by the USDA, the Department of Agriculture. And 100% financing is available for them with only 1% interest rate. These are available to people who live in rural areas, for farmers, or for people who live on Indian reservations. So let's highlight the notes here. Loans, and let's write here, loans funded by the USDA for rural homes, rural areas. Okay.
Got it.
Just give me 1 second. Got it.
Okay, everybody good?
Yes, sir.
Yes, sir.
Got it.
All right. That concludes chapter 14. Let's do the key terms to review for this chapter, and we'll done with it. There's 2 key terms to review. Start off with 1. Mortgage payments that can be taken over by the next buyer. What do we call those?
Assumable loan.
Yep, 3 is A, assumable loans. Highest interest rate ever allowed on a specific adjustable rate loan.
Ceiling.
7 is B, ceiling. Repayment plan, the equivalent of 13 monthly payments per year.
Biweekly mortgage.
Yep, 4 is C. Plan with interest rate periodically changed up or down.
Adjustable rate.
1 is D, adjustable rate mortgage is correct. Written estimate of value by real estate licensee, not an appraisal.
CMA.
8 is E, CMA. And when we do them for lenders, what do we call them?
No.
Getting paid.
Well, we do get paid for them. BPO. BPO. Broker's price opinion. BPO. So right next to number 8 where it says CMA, put /BPO. Repayment plan, the principal. Okay, wait, let me see. Repayment plan of principal and interest that gradually reduces debt.
Amortized loan.
2 is F, the amortized loan. Percentage beyond which interest rate cannot be raised at adjustment.
Cap.
Correct. 6 is G, the cap. Payment of extra points in return for a lower interest rate.
Buy down.
It's a buy down. 5 is H. The difference between the current value and money owed.
Equity.
10 is I, equity. And a VA appraisal statement is referred to as?
Certificate of reasonable value.
Yep, the Honda CRV, the certificate of reasonable value, CRV, correct. 9 is J. All right, key terms 2. Loan guaranteed by the federal government.
FHA.
Well, who guarantees loans?
The VA
The
mortgage.
VA, the VA. 10 is A, correct. 10 is A. Protection for lender on low down payment conventional mortgage.
Private mortgage insurance.
PMI, private mortgage insurance. 7 is B. A mortgage payment including amortization, interest, and certain expenses.
Pity, PITI.
Pity. 5 is C. And a pity loan is also referred to as what?
Principal, interest, taxes, and insurance.
Well, that's what it stands for. It's a loan that includes the principal, interest, property taxes, and homeowners insurance. But some people also refer to it as a budget loan.
Budget loan.
So you may want to write next to that slash budget loan.
Got it.
So 5 was C.
Oh, wait a minute.
So,
D looks like a trick.
oh, well, let's see. Percentage of property's value that may be borrowed. It's not a trick.
Loan to value.
The LTV, the loan to value ratio. 4 is D. It's how much they'll loan you in relation to the value. Right? 4 is D. Lender agrees to hold the interest rate for a certain period of time.
Rate lock.
8 is E, the rate lock. 1% of the loan amount charged as an upfront interest when the loan is made. Even though you don't got to pay for it up front, you get included.
That's a point.
6 is F, it's a point. Low down payment insured mortgage loan.
FHA.
FHA.
203B, correct. FHA 203B, 1 is G. Mortgage with payments of interest only.
Straight loan.
A straight loan is an interest-only loan. 9 is H. Charge for the use of other people's money.
Interest.
3 is I, interest. And a guide to national mortgage trends used for adjustable rate mortgages.
Index.
An index, they tie it to some sort of an index, usually the 1-year U.S. Treasury bill. So that concludes chapter 14.